and Radigan in Milan as we take you through the rest of this trading day.
So is the new April Fool's Day the 2nd or the 3rd?
We find ourselves in a predicament here. If you're joining us on the platform, if you're watching us on tastylive.com, welcome. If you're on the platform, come over to YouTube, join the conversation. Tell us what you think of what's happened here over the past 24 hours. If you've been following me today in Futures Power Hour, if you've been looking at my Twitter feed, if you watched the show yesterday, you've been witnessing a slow descent into madness. So I hope you've been enjoying it. The markets are enjoying a slow descent into madness, or perhaps not so slow. Stocks fall out of bed after the tariffs were announced yesterday in one of the most sloppy and ridiculous fashions that could have been done. To all the people out there saying that I'm just a professional managerial class coastal elitist who's upset that stocks are down, you don't know me. That's not what I'm upset about. I'm upset about how this is not going to help any of the problems that we're stating to actually go solve. It's going to make things worse. Mm-hmm. But the market hasn't fully.
Can we talk about that? Can I just go right there?
Sure, Mr. Radigan.
Can I make a recommendation from the peanut gallery?
As you were.
There's no shortage of criticisms and obvious critiques to be had here, and there's no shortage of, trading issues to reflect upon. Obviously, recession probabilities have gone up, all the things. But let us just suspend all judgment for a moment and presume that the President of the United States is correct in his desire and his efforts to return manufacturing to the United States of America. He does not work for the financial class. He does not work for the investor class. He works for the forgotten American worker who was abandoned by NAFTA and abused in the financial crisis and is now bringing manufacturing back to America at the expense of the Wall Street fat cats. Why is he wrong? Why? Not why is he wrong? Because there's 1,000 wrongs. Why do you think that? Do you when you say he won't get what he wants? Do you think that this will not help the lower middle class American manufacturing worker?
Well, right off the bat, today we have job cuts announced in the United States with companies citing the tariffs specifically. Maytag is shuttering a factory in Iowa, about 600 jobs. Stellantis is closing down a factory, idling a factory in Michigan, a few hundred jobs there as well. They're also shutting down plants in Mexico and Canada as they work through the supply chain issue. I don't know if people recall one of the frustrations of the Biden era, which was they spent all this money to build infrastructure, to electrify the grid, to connect transmission lines, to put charging stations everywhere, and it became a running joke that they couldn't accomplish a single damn thing because there was too much red tape to go through. And of course, you ascribe this to a deliberate waterfall process. If you talk to any policy experts, you can't just move on from stage one to stage two of the process until all of stage one is complete, and it goes on a state-by-state basis. So once it happens, it's going to happen all at once, but it took a long time. That is the same problem right now that the Trump administration has, because the continuing resolution that they just passed a few weeks ago extends the laws that were set forth under the Biden White House, which means all of the bureaucratic red tape to laying new infrastructure and building new factories remains. And we now find ourselves in a problem where we have these multi-year review processes, if it's NEPA or any of the other widely abused bureaucratic overreaches that are intended for good purposes, protect the environment, ensure that people aren't screwed when a factory moves into town and gives all their kids asthma. We're actually, those processes have been abused and we're not building things anymore.
So you're saying that the Trump voter, that the alienated Trump voter shall not be served?
Not in a timeline before there is an immense amount of pain if the results do boomerang back to us. It takes years to get a factory built and open here in the United States. It's not something that happens in just a few months, particularly if we're thinking about the supply chain critical issues like the semiconductors.
Can I just say, forget building a factory here. I mean, don't forget it, but just like, yes, obviously all the obvious issues of building a factory here. Now I'm going to argue against myself here, but whatever. I'm not even making, I'm just exploring. I'm just trying to find some path somewhere for somebody.
I have a path here. Like, there is a way to do this. Doing it in
There's a way to do what? There's a way to do what?
Reshore manufacturing jobs.
Okay.
And it means an entire overhaul of the entire tax code. It's not an interesting topic. I've joked here before. I get a copy of the tax code every year from my mother because she's a tax attorney, and that's not a joke. I get like a 50-pound bag of pistachios and the tax code because we do white elephant. I'm like Atticus Finch getting paid out here. All right. We need to change our tax code to a destination-based taxation system. All right. I spoke about this on Futures Power Hour earlier. One of the core arguments for destination-based tax, especially when paired with something like a border adjustment tax, is that it can incentivize the reshoring of manufacturing. Under our current system, the U.S. producers are facing a double whammy. Their goods are taxed when they're sold domestically, but imports competing with them often enter the country without equivalent taxation, especially if they come from countries with VAT systems that rebate taxes on their exports. So that creates a structural disadvantage for American-made products. A destination-based system flips that script. Why? U.S. exports aren't taxed, so American-made goods are more competitive abroad, and imports are taxed at the point of sale, making foreign-made goods less artificially cheap in the U.S. And so those incentives shift there. If you're a manufacturer deciding where to produce, a destination-based system removes the tax-related penalty from making goods in the U.S. It rewards domestic production because you're no longer competing against untaxed imports. It's not the silver bullet solution. You have to think about labor costs, regulation, supply chains, but this helps tilt the field back towards neutrality. And with a destination-based tax system in place with some sort of balancing equation, like if I could have a plant here in America or have it in Vietnam, if I want to have it in Vietnam, the taxes will need to be geared in a way that accounting for, transportation, security, warehousing, et cetera, overseas, it would just make sense to pay American workers to do it here at home. You have to level
some of this logic
the field.
is in the reciprocal tariffs, by the way. If you look at the
it's kind of in there. It's kind of
if you look at it, right, the tariffs on South American countries are all at the floor of 10%. Right. The tariffs on Southeast Asian countries and China are much higher. It does seem like there is a thread here that says we're going to move manufacturing from China somewhere. And where we want you to reshore is the Western Hemisphere, because the new Monroe Doctrine is the operative sort of way of thinking. And that's not a bad goal in and of itself. In fact, it makes quite a lot of sense and sort of factors in with the idea that when you renegotiate the USMCA, which is the whole kerfuffle with Mexico and Canada, if you look at the history, first Trump administration would tear up NAFTA, say it's the worst agreement ever, then sign the USMCA, which is nearly identical to NAFTA, but a little bit broader. So we end up with more free trade, not less. Now look at what's happened here. New tariffs on Mexico and Canada, except everything that's in the USMCA is exempt. What's the incentive there? Make a bigger USMCA, more things are exempt. Again, more free trade, not less. The building of a kind of Monroe Doctrine, we are the Western Hemisphere house and no one shall come into the house, that, and we want to reshore everything here within our immediate sphere, all of that is here. The problem with all of this, to put it very simply, and I think, Chris, this is where you're going, but in my mind, it's like third grade logic. There are more people that use steel than make steel. This is what we learned in the first round of these tariffs in Trump 1. When you do this with this instrument, you hurt more manufacturing than you help. It's really that simple. It doesn't need to be any more complex. This is free trade in reverse. If what free trade does is help most
American
people.
Brexit? Is this a version of American Brexit?
This might be more foolish than that. Because what this does effectively is this says if free trade helps most people but hurts a minority, and the object is to help the minority, then what this does is it hurts most people but helps a minority. And now you have a very big issue to solve rather than a smaller issue. Moreover, if the markets were afraid of tariffs as such, we would see this in November, but we didn't. This is not about tariffs as such. It's about the implementation. And what the president has done here is unveiled a bilateral schedule of tariffs. This is an opening bid on a renegotiation. It's going to take forever to negotiate each one of these individually. What the market wanted was certainty. This is the opposite of certainty.
It feels like there's a lot more uncertainty, and I can't, I'm trying to place my finger on whether or not the market is upset about the tariffs themselves or the methodology by which they were derived. Because when people were looking at the tariffs, when Trump was up there with his, little whiteboard yesterday, his chart, people were wondering, where are these levels coming from? And this really begs the question, or how are they approaching this in any sort of rational way of thinking at all? Again, I've had plenty of complaints about it. Just check my Twitter feed. I don't need to air them out here. But it completely ignores our service exports to the rest of the world as part of these calculations, right? When we're making stuff and selling it abroad, people are going to complain. It needs to be more than bits. It needs to be atoms too. We have to have real tangible things, not just software. But all these calculations are done from cherry-picked data that kind of don't line up with any sort of conventional or unconventional thinking about how to approach trade. And all of our allied nations, all of our friends around the world who we do significant business with are saying, like, none of this makes sense. Like, we have to protest this at the WTO, as Japan said, or we're going to just hit them back because we can't argue or deal with this right now, right? We're not. Is this a negotiating tactic? Lutnick is out with a bunch of different things today, our favorite cabinet member here on Overtime. Let's look at some select quotes. No chance Trump will back off tariffs. Negotiating is talking. No talking, just doing. Trump will stand firm. The way that countries can get this to stop is to stop exploiting us. It says if the dollar's cheaper,
you have to say all these things.
Export, but we don't have.
Otherwise, it's not the cudgel that you want it to be. There can't be a negotiation if people think you're not serious.
Right, and Mark Carney, though, today says the integration that Canada has with the U.S. over the past 80 years is officially over.
Right.
So realpolitik.
That's his pitch to get elected
to voters.
I mean,
to get
obviously
elected.
That's not real.
That's his pitch to get elected, which means he's not going to back off that rhetoric either for the next little while.
No.
Sounds like that the market is still thinking that this is going to be walked back sometime soon.
It's not enough.
I mean, that was the next place I was going, was like, is the market's response today actually still a heavily discounted perception of the actual probability of the real implementation of actual tariffs? In other words, if these tariffs were really the numbers that were thrown around, would not the market be down more?
I'm going to go back to my favorite broken record, which is to say that what the markets do when fiscal policy makes no sense and is counterproductive is they turn, as Princess Leia in the opening of the first Star Wars movie might, to Jay Powell and go, help us. You're our only hope. The Fed is our only hope. Give us the cheap money that will be the shock absorber to all of this. And the markets, I don't think, are prepared to do the full capitulation because we have NFP tomorrow and Powell speaks. And we're going to see if he comes out and goes, okay, everyone, here we go. The ISM data today was awful. It showed the U.S. service sector basically ground to a standstill. So, and by the way, the worst part of it was a collapse in employment within the service sector. New orders stand still. Okay, people are unsure. The price structure high. Okay, we've known that for a while. Employment is actively shrinking in both the service sector and manufacturing at speeds we haven't seen in a very long time. And that's maybe going to show up in NFP tomorrow. We'll see. NFP might be a little lagged. But to the extent that the numbers give the Fed clearance to act and Powell comes out and says, okay, it's go time, the markets, I think, are prepared to kind of greet that. But if Powell comes out tomorrow and says something on the order of, well, we told you already, we're waiting to see what these tariffs actually do. We have our assumptions, but we need to see what's what, and basically sounds wishy-washy and doesn't have a sense of urgency, well, then buckle up.
Dylan, when you look around the market today, you see everything growth-related is slammed. Oil killed.
I am so annoyed at oil. I got short. I got shaken out of my short. Now I'm looking at this. I'm like, what? Damn it. It's down over 7%. I would have been swimming in oil short winnings.
But what
Instead,
if Wall Street is right that
loss.
really this is still Trump drama and that this is a buy the dip? How about the other version of this, which is that none of these tariffs will actually get implemented? There's going to be a whole wave of deal making the next week to recut all these deals, and things are going to ultimately normalize, not become chaotic. That the
if
Trump
Powell
administration
comes out tomorrow and does the Draghi, I can see that.
Would you buy oil? Would you buy Tesla?
Not.
Would you buy the Russell? Would you buy the
I would
Nasdaq?
get out of my shorts. I might get out of my shorts. It depends, obviously. It depends
You're
on
saying
the
you might
market
get out of your
action.
shorts contingent on a Powell accommodation narrative.
Contingent on how the market responds to that kind of a narrative. It's all about the price action. If Powell comes out tomorrow and says, look here, we will do whatever it takes. We have all the monetary ammunition we could possibly imagine. Rates are high. We've been doing QT for a while. We'll turn this car right around. We'll give you a bunch of cuts. We'll give you a bunch of QE. We're not going to do it right now, but just so we're all clear, our finger is on the trigger and we're ready to pull. I think the market is going to unclench.
You know what the worst part about all this is? Is that the dollar didn't strengthen today.
I think that reflects what the market wants, which is easing.
I see it reflects a group of people overseas selling their equities, taking their U.S. dollar denominated capital, converting it back to their home currency.
That is surely a part of it.
And that just scares the hell out of me. That's not what
That
we
is
should be seeing.
surely a part of it.
That's what's happening, man. That's what's happening, brother. That is what is happening.
Because I mean,
People are
European
like, okay,
indexes are down also.
Solid.
It's not like this money is going into European assets or APAC assets. Everything is down today because obviously a trade war is bad all around. But to the extent that U.S. markets have outperformed and international investors are pulling capital out of it and repatriating it into home currencies, that is almost certainly a part of this dollar sell-off. But so is what's happening in ZT. Just take a look at the front end of the curve. The markets have priced in 88 basis points in cuts this year. They're basically front-loading everything the Fed said is going to happen through the end of next year for this year. Markets want cuts.
Markets want cuts.
Only
Not
reason
sure
the
they're gonna
markets
get 'em.
don't get cuts is inflation, right?
Well, that's the
And
whole
Only
thing.
reason.
all of the
That's the whole
major
thing.
forecasters came out today and said we're projecting inflation returning back towards COVID peaks and growth falling off anywhere between 1% and 3% in the second half of the year. That's kind of
And
like
look
the
at
median point.
break-even rates. They're up.
And yeah, inflation break-even rates have
I
gone up
hope
today.
that isn't true. I just hope that's not true.
If Powell comes out tomorrow and says, it's a difficult balance, the risks to our mandate, blah, 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 and it doesn't sound like he's got his firefighter hat on, then what we're seeing today is a light prelude.
Maybe that's what causes bonds to pull back in. Obviously, they had a very good day today, gapping open higher, holding up there for most of the session, although, 119 and 20 right now. Maybe that's what causes bonds to pull back, that Powell says, like, we got to see how it plays out. Our hands are tied. Isn't that the risk here, that we don't have stepping stones to get from point A to point B, that we're doing this overnight? I mean, the speed with which this change is happening, I think, is so noteworthy. Jim Bianco, who is very open-minded about giving the Trump administration a lot of leeway here with what they're trying to accomplish. He has not been critical to the degree that I have, the three of us have, right? He's certainly not in Tom's. He's probably more in Victor's way of thinking about this. This is the chart that he shared yesterday, talking about just a shock to the system. Jim Bianco of Bianco Research. This is where our tariffs rate are, and this is how quickly they're shooting up to levels that we literally haven't seen since the 1910s. This is in excess of Smoot-Hawley and the Great Depression, right? This is a shock. This is a supply shock to the system. This is a self-induced shock to the system. It's not like this is a graduated thing. We're going to be moving to these tariff rates over the next year, and we're starting off with a 5% bump, and every 3 months, we're going to move them up another quarter of the way. And that way, if in 12 months, you're going to be at the 100% level that we're threatening you with here today. So you have some time. This is a
Moreover, it's not legislation.
Shock.
It's executive fiat, which means you can't trust that this stays.
It can be undone. That is also the big problem here. That if you're a company, if you're Nike with your 550,000 employees over in Vietnam, which was wild to read about today, but their share prices fell out of bed by 14.46%. If you're Nike and you see that this is done through executive fiat, do you move your factories back to the United States? Do you switch operations to perhaps a Latin American country where you already have some factories and you ramp them up there? Why would you bring them back to the U.S.? Because odds are these could be undone.
Congress is already starting, right? So Congress is already starting to push back on the tariffs, in this case, localized to Canada. They've gotten Republicans to vote on it to push back some of these tariffs. We didn't even have to wait for an administration change. We didn't even have to wait for midterms. First rule of politics: protect your own behind. These people understand that workers in their constituencies are going to lose jobs over this. Congress is already starting to undo it in bits and pieces and fits and starts. So besides the fact that you now have a bilateral negotiation with everybody from the European Union to Botswana, you also have the inherent impermanence of the regime. First of all, because the president has shown a capricious nature. Things are on, things are off, things change all the time. That's one issue with executive fiat. The other thing is the next executive can easily undo this. And of course, the third more immediate thing is that Congress can undo it and is starting to undo it already.
So if you're
a business, why in the world would you change anything on this basis?
Dylan, you would probably remember better than I do. Tell us about how TARP 1.0 and Congress's inability to solve the problem quickly resulted in the market melting down more. And I ask you that because it feels like there's a parallel here. If Congress only acts in fits and starts to remove this piece by piece, this feels like this is a TARP 1.0 situation.
What you're getting at is, for the financial crisis in 2008, it was not until there was a catastrophic, unlimited intervention by the central banks at every layer of the market, from commercial paper, long end, short end, high end, short end, tall end, any end. And as long as there was incremental intervention of any kind, it only catalyzed much more severe selling, which I suppose is what you're kind of getting at.
Because then it says the thing that we just did wasn't enough.
And it says that the people in charge don't even understand what the F they're doing, as evidenced by the fact that they're taking these incremental interventions.
It just comes across as weak and indecisive.
Weak and incompetent.
If Congress is going to act to stop this, Congress has to do it in one fell swoop. It can't just pick and choose, otherwise the selling continues. But hey, you know what, Ilya?
This is the uncertainty we're talking about.
We to ride Elliott wave theory. A, B, C. 17,300 becomes your target in a NASDAQ pullback. S&P 500 now down 5.12% here, still falling after hours. A, B, C, 5173. Equity markets could still have some flush to them. I think that's what also alarms me about today. You look at the flow on the tape, we barely got to a 30 VIX by the end of the session. Barely.
Technical damage is not nearly enough to say that what you've had is a capitulation low. This is not capitulation.
This does not feel, in my personal experience, granted not as long as others, but it doesn't feel like a low now, given the tape.
Just look at July of 2008. Everybody likes to talk about Lehman. Oh, Lehman. Lehman was the crescendo, not the start.
We felt more, by the way, on Lehman Monday than we felt more today than we did on Lehman Monday, if that is of any interest to anyone.
And that was just beginning of a process that ultimately was the crescendo, and we didn't really bottom until February, March of 2009, and we were selling long before then. Go to something like a mid-July of 2008, and what you find is that the process is just warming up at that point. The euro, for example, peaks out on a test of 160, and then it's mid-July that the markets go, the world is ending, cash out everything, and the dollar starts rallying. Months before Lehman. We're just getting started here, if this is how this is going to go. This is an appetizer.
Oh, yeah, this could get a lot worse.
This could get much uglier.
Yeah, Dylan, you asked the question at the start of the show: is Wall Street still swimming in a sea of, its own nonsense, that it really hasn't fully priced this in yet? We've come 10% off the highs.
I was just sort of conjecturing that it's like, if you buy the rhetoric, which is Trump doesn't care about Wall Street, Trump's working for the working man, and it's screw Wall Street. It's high time finally a president worked for the working man. But the issue is, I don't find that to be credible personally, because I don't see the benefit to the so-called working man from any of these policies. I see it through the same lens as Brexit, but to your point, maybe worse. And the other thing is, it's all political. So I also think that there's an incentive for the Democrats to stand out of, like, when the one of many sort of saying, I guess, but when there's a runaway freight train, the best thing to do is step back, get out of the way, and let it hit the wall. And so there's an incentive for the Democratic Party to do nothing right now.
I think that's awful.
And let the Republicans do as much damage as humanly possible to the global economy and the American economy, because it's in their political self-interest in 2026 for the American economy to be a catastrophe, even if that's an abdication of their responsibility to be a custodian of the people of America. And that the Democrats, I believe, are just as willing to sacrifice the people of America for their political self-interest. Furthermore, the only reason Donald Trump is the president is due to incomprehensible incompetence on the part of the Democratic Party in their inability to actually run a normal primary and field a presidential candidate who could have credible standing in the electorate, which they refuse to do, which is the only reason, in my opinion, why Donald Trump is the president in the first place. And now the Democrats basically allowed a fruitcake to become the president, and now they're standing out of the way to let the fruitcake run the fruit train straight into the wall so that they can then get political advantage in 2026 without any self-reflection as to what it says about them that the American people preferred a fruitcake to what they were offering.
Let's go to the great book, Geopolitical Alpha by Marco Papish, where he talks about this really great concept called the will of the median voter. And what he talks about is this idea that even in non-democratic countries, leaders, lest they want pitchforks and torches on their doorstep, have to kowtow to some extent to public opinion. They have to give people at least the appearance that they're doing the thing that the people want. We obviously see that not just in the US, but internationally. There has been a backlash against globalization. There has been a backlash against immigration policies. There has been a backlash against China and the sort of free rein that it was given with its admission into the WTO and sort of everything that followed, the sort of aspirational perspective on China, saying, well, let's just give them the access now, and that will discipline them into international norms, rather than let them first become disciplined to international norms and then let them in. Not unlike the absorbing of Portugal, Spain, and Greece into the Eurozone before they were ready. A sort of aspirational move that, of course, later turned out to be a giant crisis. So the median voter has already expressed displeasure with all these things for a long time. What I think you're seeing around the world is there's a lot of people that recognized this and then a lot of people that didn't. And the people that didn't aren't winning elections. And the people that did are not sticking the landing on implementation. So the thing to do for people that want to win power is to recognize the moment, but then to implement well and in a sane fashion.
I do want to address something that just came in here over direct message. I think someone's listening right now. Chris, I saw that markets are in turmoil on CNBC. This is a very important sticking point for us here on Overtime.
Wow.
That is not true. That's
big.
not true.
That's
not true. No, but it didn't happen. I want to just put that out there.
Okay.
The Federal Reserve is not likely to rescue markets and economy from tariff turmoil anytime soon.
No,
that's not it.
No, that's
we need the Chiron.
Turmoil.
We need the PM special.
That's what we're looking for.
8 p.m. Eastern is the key.
That's what we're looking for.
Right? You need the big evening special. You need the Chiron. Now,
that's when you back up the truck. That's when you borrow from your uncle.
That's right.
Exactly. Right. So this is the headline has the words markets and turmoil on CNBC. That is true.
No,
we are looking for something very specific. It is this Chiron. It's this image. If you see it, send it to me. My kids' college fund will thank you.
The cover of The Economist this week, very important to look at as well. We'll see how that goes.
But why do we bring up this cover? I want to remind everyone, because we haven't talked about it in about a month. Charlie Bilello on Twitter from Compound. Every time that CNBC has run this, period, it's been a 100% positive hit rate a year later with an average return of 40% higher for stocks.
Every Time.
And not a small sample size either, like 63 occurrences.
No,
right?
no. Solid. Statistically significant.
So that's why we joke about it, but legitimately it is one of those, okay, if you've seen it ascend to this level of fear, then you're probably in the bottoming process, which
I hosted a bunch of those, by the way. I was the host of a number of markets and turmoil APM specials, particularly in 2008. I'm just so you know, you can thank me. Your children, were they to exist in 2008, which they didn't, but if they did, should thank me for their sort of luxurious college lifestyle in the future.
The cover of The Economist this week has Donald Trump with a saw, and the tag is Ruination Day. So I'm not sure.
I like that. I saw that cover. Mm-hmm. I thought that was very.
I'm not
creative.
sure we're quite there yet. I'm not sure we've kind of reached. I think we're still kind of noodling on tariff policy. We haven't
How
gotten
about that bond position, though, Spivak? You got that thing working, my man.
Not mad at it.
Beauty.
Not mad at it.
I thought of you this morning. I was like, my man in Portola is feeling all right.
Pretty good. I like the euro. Yeah. I like that long. That's working.
Looking good.
Well.
Looking good.
I'm also
feeling good, Billy Ray.
Feeling good. Right. Looking good.
I'm also looking with a lot of curiosity at Chris's favorite racehorse, because you'd think gold would be up, but it's not, and that kind of it's an interesting sort of thing.
I felt like people were raising capital today.
I get that sense. I was also talking.
Silver scares me. Silver scares the hell out of me, though.
I was also thinking a lot about this and how gold has basically ignored yields in the dollar in this entire run-up, and sort of thinking about gold is, let's say you have a war that breaks out, right? What happened when Russia initially invaded Ukraine, right? Gold surged. Why? How is gold a haven against Russia invading Ukraine? It isn't. But the reflexive thing is people go, I don't know what's going on. The one thing I can do is buy some gold because that's a thing I can do when I know nothing else. So if you look at then the rally in gold in the context of the tariffs, you go, well, this is a warlike response. And so now that the invasion has ostensibly occurred, you've had the reciprocal tariff announcement, you see the damage, the uncertainty of just whether the invasion would or wouldn't occur is ebbing out of it. And people go, okay, now we know that the release valve is the Fed and the dollar is going to get shellacked because yields are lower. Okay, we have a playbook here. And the playbook is chaos. If you don't have the playbook, you buy gold. If you get the playbook, maybe that part of it is over.
So today's action obviously has a very defensive tone here, as you know, can only speak from ourselves. This is more market commentary than strategy, but you know, the AI power names are really helping here, guys. That was one of the insulation points today in this market. EXC and Duke breaking out. We talk about power demand going up and potentially straining our relationships with everyone else in the world. Will power companies, because we can no longer blend power in from like Ontario, for example, would that be something that helps domestic power providers? I would think so. It gives them a more monopolistic position. So EXC here is continuing to surge. Earlier this week, we talked about putting a position on in Duke, which was the double bull, short the put spread and long the call spread at the same time. And that now seems to be breaking out after today. So these are the winners right now. I mean, that's really what you have to think. If you're thinking about a market where you're looking for some long delta opportunities, it's not necessarily going right to tech, which is trying to catch a falling knife. It's looking at what worked well today, what didn't really have that significant of a pullback in today's session. And if you have spikes in volatility in those areas, you probably can start operating on the long delta side in those individual equities. They're not going to be the sexy names, although Philip Morris. Yeah, I think all of us could go for a cigarette after today. Like, this is, a company where you have a 109.3 IVR, 10.6 million shares traded today, and it's breaking out to a new all-time high. So if you're looking to sell a put spread in stocks, you have to kind of pick and choose where you do it right now. And do we think in a world where, there's this much stress in people's lives and the prospect of higher unemployment rates in the short term, which legitimately, maybe the tariffs work out and cause all this reshoring and all this is for nothing. In 3 years, 5 years from now, we can look back and say, hey, that was a lot of pain, but it was worth the gain. I don't think that will happen, but, I want the country to succeed. I think a lot of people are going to be stressed out in the short term.
Yeah.
So owning a cigarette company seems like a tongue-in-cheek good idea, but it's a staple. It's a staple. PepsiCo is a staple that's moving higher today, right? Unlike other stocks, it's holding up throughout today's session. It has a 93.4 IVR. We can operate on the long side still selectively. I feel much more comfortable selling a put spread in a name like a PepsiCo or a Coca-Cola or a Duke Energy or an Exelon right now than I do when I look at the NASDAQ and think 5% down, this is a gift. This may be a gift if you're a long-term investor. As a trader, we have no idea what's going to happen next. And I said earlier this week, I had no conviction whatsoever. I was, this is the outcome that was possible in the fat tail. This is the fat tail realized. And I only wish that I had acted on those feelings a little bit more. This kind of sucks. This kind of sucks. This kind of sucks. Dylan, what's your give us
I'm happy I bought the bond. I'm happy. I woke up today. I saw this whole situation. I'm happy that Ilya sort of pointed me in the direction of the bond not that long ago. I'm unhappy about the euro-dollar relationship just because I live a life that earns dollars and spends euros, and it's not that felt like a personal assault from the president, but we'll set that aside. I ultimately go back to a conversation I had with Angeline with IG in Europe yesterday morning, which is to sort of settle into there's going to be this is 2025 is going to be a bad year economically. There's going to be a recession. If there's going to be a recession, it will finally arrive. Other than owning the bond, what do I want to do? Which not to become sort of redundant to what you just finished doing correctly, Chris, which is okay, consumer staples, utilities, you just kind of flip through those charts. And I guess the debate that I'm having, which I'm happy to hear feedback on, is, am I better off to own more bonds and more consumer staples, or should I be noodling around with this opportunity of a lifetime to buy myself some Amazon, to buy myself some Tesla, to buy myself some Apple? The hyper growth, the Mag 7 are getting face pounded, and now's the time. And so the question is sort of, or do you do both, or how do you even differentiate between the more conservative position, which is own the bond, own staples, wait it out, and the more aggressive position, which is sure, own the bond, own some staples, but come on, party boy. Like, if you want to, you think Apple's going away, you think Amazon's going away, you think Meta, Tesla, is going away, unlikely. So Get them while they're cheap.
I don't know. I feel like a lot of countries would be happy to use this moment to get Meta and Facebook out of their ecosystems, right?
I don't doubt that, but I'm not sure that's so easy that's easier said than done,
Yeah, well, you're taking something away from people, and that's going to stink. Meta obviously has a very big breakdown here, but again, you talk about the significant technical damage, or Ilya's been, saying significant technical damage. This is falling through a lot of support very quickly. It's an area that we bounced off of just last week. Maybe that's what we need to contextualize here. Compared to last week's low, 553.30 in Meta. Today we're at, 531. We're not talking about something enormous to get a little bit higher here. Meta could move that very easily in a day or two and get back to a place where we were at the start of the week. And all of a sudden you're like, okay, what's the damage? I think that's a fault. This is a sell the rip, not a buy the dip kind of environment right now. And you can see it across the board. What did Scott Bessent say yesterday about the declines in equity markets? That's a Mag 7 problem, not a MAGA problem. That is an awesome line. That's a great line. That's a really
great line.
It's a great line. Got to give it to him. 45.2 IVR in the mags, so volatility really hasn't pushed up here. We haven't seen it blow out. We look at the volatility futures curve right now. If we go out to VXJ, yes, it has jumped, but it's 26.4. We can keep going out. We'll go out to June, 26.38, right? You're not seeing crazy numbers here on the board just yet. 22.5 for September. We're in backwardation, but stocks don't like backwardated VIX futures curves. Mike Butler was talking about this yesterday with us, Ilya?
Mm-hmm. That's right.
How stocks do not rally when you have a flat vol curve, futures curve, or you have one in backwardation. You needed to get back into contango. And we move further away from that today. So it's difficult skis here. I guess in terms of some position management, I'm going to keep bonds on for the time being. I think you are too, Ilya. I guess there's a question of what to do with silver. Two sides of this coin. We rolled it earlier this week to get out of the way of being at 21 or 22 DTE on Friday. Good, because this would have turned a winner into a loser. This is now a loser, and there's some 80-odd days to expiration. Volatility is creeping up. I'm going to have to rest on my fundamental laurels here. That in recessions, bonds and metals are the place to hide. That served me well so far this year. It obviously sucks on this particular trade. But gold's only off less than 1% throughout all this. We talk about the gold-silver ratio blowing out. Mm-hmm. If we drop below the swing low that we had at the end of February, because we haven't cleared the March low yet, if we clear that out, then I'll just take the loss and go back to the drawing board on this particular small. It's eating dirt. I couldn't get filled on copper today either. But the long term here is if you're looking at the SI N5 contract, Ilya, you prefer your horizontal lines more than your diagonal ones. If we get down below $31.67, I'll cut it because right now it's basically at max loss. So what the hell? Might as well have it. See if we get a little bit of a bounce back. This didn't work. This didn't work for me today. Obviously, buying that 5,800 call for Friday's expiry didn't work for me yesterday. And crude oil, my geopolitical kicker, this one didn't work for either of us. But I actually want to add one more layer. We talk about connecting dots for what's happening in the Middle East right now. Yes. We've started to move even more assets over into the Middle Eastern theater. In recent days, there was, if you guys follow OSINT, or I think his name is OSINT Defender on Twitter, he pointed out earlier in today's session, and I'm not speaking to this anything other than the fact that this guy tends to tweet a lot of military stuff, news, yada, yada, yada. He was talking about today how not only do we have carrier strike groups that are moving and relocating into the Middle Eastern region, we're going to have 2 aircraft carriers overlapping there. We also see that the Pentagon has ordered the relocation of at least 2 Patriot surface-to-air missile batteries and one of our THAAD systems, the Terminal High Altitude Area Defense System, to be moved from where? Asia into the Middle East. I'm going to roll down. I didn't do it yet. I wanted to see where we settle. I'm going to roll down the call spread that I purchased earlier as my geopolitical war hedge. I think it's a lot more appealing. I want it to be $5, $7 above where we were trading just a few days ago. So I'm going to roll this back down to like 72. But I'm feeling like, given all of the chaos that we're seeing right now in the news and some of these military assets being moved around, maybe it's posturing. But now there's 3 points of interest here. Threats over the weekend to bomb Iran, moving planes and bombers, B-52s, to Diego Garcia, moving a strike carrier group to overlap with another one's presence in the region, and now we're moving one of our THAAD systems and Patriot battery systems out of Asia into the Middle East. This is a buildup that's happening.
Yeah.
I'm gonna. You're saying Trump's gonna bomb Iran?
I think that Israel is gonna bomb Iran. Just like Israel in the 1980s bombed the Osirak reactor when Saddam was still ruling Iraq. They just went in overnight and just completely wiped out Iraq's nuclear weapons development facilities. and obviously lots of hand-wringing, blah, 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 but it was done with the U.S.'s blessing. I think that's a very credible threat on the table.
Absolutely. And one thing to keep in mind, all of those shenanigans last year where Iran shoots some missiles and Israel shoots some missiles, the Iranian ones didn't really do anything in the grand scheme of things. The Israeli strikes significantly deteriorated Iran's air defenses. If there were a window to say, we're going to launch these strikes and Iranian defenses are not up to snuff to repel it, this is the weakest they've been in a decade plus. So very credible to think that this might be something that has some sort of legs onto it, especially since the posturing politically in Israel seems to be to extend broader and to do more, not less. Interestingly, all of a sudden there's strikes in Syria. All of a sudden there's strikes elsewhere. It's almost as if, and The Economist made this point, I thought, very eloquently. They said before, Israel had the U.S. to come and tell them when to stop fighting, when the battle is won and you can settle back. We don't have that here. So this could be, they might just decide, you know what, we're going to get it while the getting is good. And if that means overextension, we'll worry about that later. But I think you're right. I think very credible to think that they might opt to escalate.
Along those lines, I would look at a company that today came out unscathed throughout all this. If you don't want to play in the crude oil pool, Lockheed Martin has a 91.6 IVR. It was up by 0.42% today. Again, a survivor on a very bad day in this market. Recent swing lows coming near 420. If you wanted to bracket that, like a 400, 425 short put spread or tighten up the strikes a little bit, you could look at something that's going to give you like a 2.5 to 1 risk to reward. With a probability of profit of somewhere in the 60s or 70%. But I think that's the game plan for tonight, folks. You know, if you're going through your watch list, if you're going through your watch list and you're looking, okay, I have capital to deploy, I need to clean up a mess, make your position adjustments, right? The goal here is to not hold on to losers that are running. It's to cut them ruthlessly and then adjust, and then always adjust. As traders, we have to be willing to let go of any preconceived notions, strong convictions always held loosely, and really you don't hold them that tightly whatsoever. But if it held up today, of all days, right, and it has high volatility, it's probably going to hold up if stocks do bounce back, right? Costco, for example, fits that quite well, up 0.21% today. Right? Why is that the case? It was down earlier, comes back because people are still going to have to buy stuff and survive. And companies that source their stuff domestically are going to have an edge over their competitors. We have to think differently. This is a different market. There's a regime change going on. Do the tariffs stay? Do they not stay? I don't know. Could they do lasting damage? Perhaps. Could they lead to great success? Maybe. I don't think so, given global history. But this is a crisis market environment right now.
Yeah, I mean, to your point, you can have all these high-minded conversations about the long-term economic consequences, but that's hardly the objective as a trader. As a trader, you have to trade the price action in front of you. And just like I would concede repeatedly last year, saying I have all these reasons to be short, I'm going to nibble when it looks like it might be time. But the moment the market proves me wrong and the price action says no, I'm not going to sit there and go, no, but I'm right, though. I'm going to run away. I'm going to do it with verticals to keep my risk contained because I am not going to roll the dice on an idea when the market is telling me, back it up, this is the wrong time. It applies exactly the same way in reverse. The market is setting lower lows and lower highs. This is not the time to be a hero.
Dylan, final thought as we close out overtime for this Thursday and this week.
Don't overthink it. Get long the recession and tie up your horses because it's going to be a bumpy ride.
Mm-hmm. Mm-hmm.
Well, we'll be here tomorrow, of course. Ilya will be back in about 30 seconds. But overtime is done for today and this week. We'll see everyone shortly on Macro Money. So for Ilya Spivak, Dylan Radigan, I've been Chris Vecchio. Good luck trading. Hope today was not terrible. See you tomorrow.
Okay, well, this is me. Thank you so much for tonight. I've never been to the Hard Rock Cafe before. That was really fun.
Bow, bow.
Okay, well, this night.
This is a song for the broken hearted. Bow, bow.
Okay.
Hey.
All right.
Why don't we get up there and you can lay some hands on me, and I'll see if you're slippery when wet.
That's really inappropriate for a second.
I want to lay you down on a bed of roses and send you off to Slumber Town in a blaze of glory.
No, don't say things like that because my boyfriend was an aerial artist and he used to do things like that.
I might be Monday now, but someday I'll be Saturday night. You give life a bad name. Whoa, shake it up just like bad medicine. Bad medicine is what I need. I'm going out in a blaze of glory. Take me now, but know the truth. 'Cause I'm going out in a blaze of glory. Lord, I never dreamed.
People are always asking, where can they find my podcast? There it is, son. Look at that. Option Trades Today. You can listen here.
And everybody's waiting for my podcast tomorrow. Option Trades Today, every Tuesday and Thursday around noon. If you want to learn, sir, every Tuesdays and Thursday, Option Trades Today. You can find me on YouTube or wherever you find your podcast.
Option Trades Today. Are you listening to me? Option Trades Today comes out every day around noon, every Tuesday and Thursday. You too can stick with the bat.
If you missed the live show, here's our cherry on top weekly recap.
You are making it seem I want to go.
I know you do. I know you do. Listen, there's a lot of things I want to do too.
I'll be the
night last night. I didn't have it in me. But back in the day, I could do it. I'm older now. You know.
Omaha.
Hold on, what did you want to do last night? I missed that.
Don't repeat that. No.
No, what did you want to do?
Do this every time I'm here.
I just want to know what
Every time I'm
what did
here,
he say
we gotta
he
go down
wanted to
this
do?
road.
What did he say he wanted to do?
Do you need me? Do you want me to?
Because usually when he wants to do something, he just said, she says, go in the and do. Here you go. Here's the. Yeah, get in the. See you later.
Nick is going to be sick.
The last 3 weeks I've been on this show on Wednesdays, it's gone down this rabbit hole.
Nikki's about to throw up.
What do you want me to do? I got 3 old guys talking about. Like, what do you want me to do?
Nikki's about to throw
The
up.
thought of you guys is like sickening. I'm sitting here like this, like, it's hot as hell in here. I'm like sweating, like it smells. Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Just for a minute, let's forget about your favorite stocks. Just for 1 second, let's leave specific strategies on the shelf. Let's talk about what really matters. Your portfolio. How do you build it? What should you target? How do you manage it day to day? The answers to these questions and more are inside our newest crash course. So I'll see you there.
I'm just gonna wait for the stock to dip, then I'm a buyer. Buying into weakness is a phrase used to describe the action of getting long a stock into a down move. It's a contrarian trade. Most people want to buy what's hot. The stuff making huge upside moves, the chart line moving up and to the right. Nobody wants the stock at lows, but it's hard to buy high and sell higher, rather than buy low and sell high. There is a phrase for this. When the time comes to buy, you won't want to.
The beauty of Thinkorswim was that we were different. From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Liberation Day has come and gone, and it seems like the net impact so far has been to liberate stock indexes from some of their lofty valuations. It is an absolute bloodbath out here on Wall Street and across the broader markets. And of course, what we are going to try to unpack here is what comes next and how this develops with still more heavy-duty event risk on the calendar. This is Macro Money. I'm Ilya Spivak, head of Global Macro here on Tasty Live. And we're going to try to see if we can't make sense of how this progresses. We'll start, of course, with a look at what has occurred here, why it occurred, then see if everybody's favorite savior, Fed Chair Jerome Powell, can talk the markets out of outright pandemonium. Here's the stock market. Needless to say, it does not look great. The S&P 500 craters, and this is not unlike things we are seeing in other indexes. The NASDAQ looks very similar to this. These are both indices that are recording the lowest levels in 6 months, essentially back to September here. And if we look at the Russell, the small cap index, that's down to the lowest in a year. The flip side there, we have on the bonds a rally, as one might expect. It's concentrated at the short end. This, of course, the long end. And we can see that we're still scraping around the highs, but clearly back into a rapid advance here. And the story is, as we've described it a lot here on Macro Money, the sort of implementation of the new U.S. administration's trade policy and the effect that it's having, the chilling influence it's having on economic activity. And just to quickly catch up on the logic here, consider that the president has talked about using tariffs extensively on the campaign trail, going into the election, and of course after. So if the markets were afraid of tariffs as such, we would be seeing this pandemonium much earlier. We would be over here in November looking for it. That was clearly not the case. The pandemonium starts here, middle to late February. This is the first big sell-off. Then, of course, we get a little bit of a correction, and then the sell-off has clearly resumed and is now setting lower lows. This is very much a market that is, by definition, a trend lower, the same way this was, by definition, a trend higher. Higher highs, higher lows, lower highs, lower lows. And ostensibly, the reason that this begins where it does, the reason that stocks wait until February here to really make a move is it's not about the tariffs for tariff's sake. It's about how they're being rolled out and the uncertainty therein. And you really get a sense of what that is when you look at the GDP now forecast or nowcast from the Atlanta Fed. And it's not really the level that you're looking at here. The level is ultimately secondary. It's still quite some time before first quarter GDP numbers are published. The idea that we're looking at a 2 to 3% decline, or let's say a 1 to 3% decline somewhere in here, that's still very much open for debate. But that's hardly the point. This is a nowcast that is updated multiple times a week, usually. Anytime you get a big piece of economic data, sometimes it's updated daily if that data is coming at a faster cadence. What this tells you is the tone of that data and the extent to which the real economy is actually suffering around this uncertainty. So what you're seeing here is, of course, the woeful PMI numbers, the scary consumer confidence numbers, on and on and on and on and on. And the sum total is, it's not that the tariffs are philosophically good or philosophically bad. It's not that economic theory on them is right or it's wrong. It's not that the president is incorrect or correct in implementing them this or that way. It's that the way that the tariffs have been getting rolled out, for whatever reason you wish to construct, is having a real dampening effect on economic activity, and real economic data is telling you that the economy has significantly suffered as a consequence. Why was this Liberation Day announcement then so damaging? Well, what we got was this schedule of tariffs. And never mind what the rates are. The reality is that there are these rates bilaterally for a whole host of countries. And what this then sounds like in its inherent construction, and the market sold off overnight as soon as they heard this, is that there is a baseline tariff rate of 10%. And if the markets had it left just there, they probably would be up today, because that would imbue them with certainty. Companies would know how to adjust investing decisions, hiring decisions, supply chain arrangements. But no, what we have here are individual tariff rates that are ostensibly an opening bid on bilateral negotiations, country by country. Moreover, these rates are done by executive order, which first of all means that Congress could overturn this entire situation. And in fact, they've started doing that piecemeal. There was already action done to reverse some of the tariffs on Canada. Moreover, whoever the next executive is could just, by executive order, cancel them. And if you are a business that needs to make the plans that you need to, let's say, reshore manufacturing, because now there's a heavy tariff on Asia and not one on South America, broadly speaking. We'll notice there's a lot of preference here for South America. They only see the 10% base tariff for the most part. whereas China and Southeast Asia and Asia more broadly sees larger tariffs. So there seems to be a thread here to move manufacturing both onshore and closer, so to near shore. But if you're going to do that, that's a long-term process that takes years. Are you going to have the certainty to do that if the next executive can simply say, I don't like it, and cancel it? Well, maybe not. How long will these negotiations take bilaterally? A long time, most likely. Some months at least. Do you then have certainty with what the regime is going to be to make all those business decisions that you need to make? Probably not. And so if the problem here wasn't tariffs per se, but it was uncertainty about them, well, then the way that these reciprocal tariffs have been rolled out, and we can see this in the market reaction clearly here, it only exacerbates that uncertainty and the fog with which businesses and consumers have to operate. We see that in spades in the ISM service sector data that we see updated today. We now have both manufacturing and services. Service sector in the U.S., of course, the absolute critical engine, not just of U.S. growth, but of global growth. Really from the middle of last year, as we've talked about quite a lot here on the show, the situation in the global economy has been that the three major engines of growth, the U.S., the Eurozone, and China, have given us incredibly lopsided results, where China has been stuck in a deflationary slump since before exiting COVID restrictions, and none of their stimulus appears to be helping. The Eurozone has been in shallow recessions on and off over the past year or two. They're anemic. And the only bit in the U.S. that's been growing and growing quickly has been the service sector, largely powered by domestic demand. In fact, this is why U.S. economic strength was not spilling over to the broader world last year, because most of the demand was for services, and most of that is serviced by American firms, whereas most imports are of goods. But goods was not where the demand was. And so the U.S. service sector was really the one leg of the stool holding up, without which a global recession was almost inevitable. And what we see in this ISM data is that the U.S. service sector has ground to near standstill. At 50.8, in the logic of PMIs, you're barely growing at all. 50 is neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what you find then here is, of course, earlier in the week, we saw manufacturing contracted at a faster rate than expected. But that wasn't necessarily surprising to a terrible extent. A contraction was already in the forecast. The deviation from where the service sector was expected to be at 53 on the PMI reading is quite significant, where the difference is down to 50.8, which is only a hair above 50 and barely enough growth to avoid total stoppage. Moreover, if we look at the details of the report, we can see very troubling things indeed. New orders growth basically stalled, right down to 50. Employment shrinking rapidly. Here, we're in contraction territory at the fastest rate since the beginning of last year. Meanwhile, the price structure still very much points to rapid rise in input costs. And of course, when earlier in the week, we were taking a look at the manufacturing side of this equation. This is ostensibly where the tariffs hit the most directly because, of course, tariffs primarily are aimed at the goods side of the ledger, since, again, this is what the U.S. tends to be an importer of. If we take a look at what's going on there, of course, the cost structure is even more ominous. But here, too, new orders are outright contracting, as is employment. And so the damage to the economy is quite real, even though the tariffs are just being implemented, though, of course, the tariffs already in place already exceed those that were set up in the entirety of the first Trump administration, and that's before these reciprocal tariffs are announced. Now, from the market's perspective, it seems clear that the administration is impervious to market discipline, at least for now. The soundbite from Commerce Secretary Howard Lutnick was that the stock market sell-off is a problem for the Max 7, not a problem for MAGA. I think that sort of captures the mood in the administration. And so from the market's perspective, then, where to look for a release valve is in monetary policy. Not unlike what happened in the wake of the 2008 financial crisis, where in the U.S. you had this protracted fight over government spending, and there was really no big fiscal impulse. And so monetary policy had to go through all of these rounds of QE because that's what was the relief of last resort. And the markets are seemingly thinking that's what's going to happen here. We have, at this point, added almost a full rate cut to the overall Fed outlook. We can see, of course, most recently the Fed updated its summary of economic projections and endorsed the view they had back in December, where they're looking for 50 basis points this year from 4.4 to 3.9, and then 50 basis points next year from 3.9 to 3.4. That's a total of 100 basis points, or 1 percentage point in cuts. The markets are already north of that in terms of the cut tally. We're out to 119, so we're already out to 5 cuts, and pretty much 6 basis points shy. And as we can see, most of them are very much focused on this year, almost a full 1% in cuts already on the menu for this year, but certainly 3 of them already priced in, and then 1 with an option for more on the menu for next year. If we look at the path for this year, we can see the first cut already almost priced in for June, second one in September, third one by December, and of course, in that we are in excess of 75 basis points here, there's room for dovish surprise in all of this, which of course now points the spotlight directly on the U.S. jobs report. Expectations here are the economy added 128,000 jobs, while the unemployment rate went up to 4.2%. The markets ostensibly would be happy with weaker numbers, if only it meant that the sweet, sweet relief of rate cuts would be closer at hand. But whether it is or it isn't, we'll get an almost instant clarification, because a mere handful of hours, 3 hours after this data comes out, and whatever comes out in it, Chair Powell is due to speak on the economic outlook. It's the second month in a row now that he is there to speak directly after the jobs report, almost as if this is a press conference after a policy announcement. It is already, by the way, interesting that the Fed feels the need to comment on critical market moving data on the day of, to let the markets know how to interpret this through the Fed's lens. It sort of speaks to how tenuous the environment is. Typically, the Fed doesn't like to immediately jump into the speculative muck by commenting on the data as it's occurring, but clearly they feel the need to make themselves heard and guide the market's thinking. So we're going to get this data, and if we look at the way that U.S. economic data has been performing relative to forecasts, we can see that it's narrowly tended toward disappointment. When you're below zero on this Citigroup Economic Surprise Index, it tells you that economic data is tending to underperform relative to consensus expectations. And that's usually because there's been some sort of turn in the economy, but analysts' models have not caught up with that turn and need to adjust. And so until we get that adjustment and this thing moves back higher because there's been a realignment of forecasting and reality, the forecasting still runs the risk of undershooting whatever is actually occurring. And so you have this space then here for downside surprises. But whether a downside surprise on this data will really be impactful or not probably has to do with what Powell says. Now, in the wake of the last FOMC announcement on the 19th of March, Powell said, we see the consternation, we see the warning signs in survey data, or quote-unquote soft data, like ISM, like the S&P Global PMIs, like the University of Michigan Consumer Confidence data, which has cratered as inflation expectations have jumped. But from the Fed's perspective, this could be episodic sentiment and not something that's long-lasting necessarily. What the Fed wanted to see, according to Powell, was the consternation show up in hard data, and NFP, of course, is high at the top of the hard data list. And so we might get this number to disappoint, but whether the Fed takes that as a reason to feel a sense of urgency is really what is necessary here. And if Powell comes out and says, well, yes, there's a lot of consternation in the markets, but we don't want to get it wrong. We see the economy slowing as a consequence of this, or at least taking a hit, and we had this in our forecasts. You can see that the Fed downgraded expectations for growth in March, but they also increased their expectations for inflation, anticipating that adding an additional tax on imported goods will just make the price of those goods higher. At least that's been the historical example, and certainly the Fed isn't wrong to cite it. We see the same thing in the ISMs. The price growth component is not falling off in services, and it's running away to the upside in manufacturing for obvious reasons. And so if the Fed then decides, in Powell's telling, to sit on its hands and let the balance of risks work its way out to where it's unmistakable that they can put inflation in the back of their mind and fight the growth and employment fight, that if the Fed is still inclined to wait and see how things shake out, well, then the market doesn't get its white knight. And if that is how this ultimately goes, then seems to be a lot more selling of stocks to be done and a lot more future easing to price into the long end of the curve, as the market reckons the Fed is going to have to play catch up, and quickly, if it delays for much longer. That is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back with Chris for Futures Power Hour tomorrow, as I am every Friday. I'm also there on Mondays, on with Victor Jones for The Price of Truth on Tuesdays, also on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for watching. If you're doing so on YouTube, like and subscribe. Good luck out there. Macro Money's back next week.
All right, yeah, I'll talk to you. There she is. Good, you found the place. Good, you're not stupid. I dated 3 stupid girls in my life. I loved every one of them. So maybe you're the next one. Having a good day? I'm having an awful day. But then it got really good again. So I'm feeling all right. Hey, where'd you go to college?
I went to
University of Penn State Community College. You didn't know they had one of those, did you? Yep, the Fighting Rams.
Oh.
I'm one of the Rams now. Do you have any sexual fantasies?
Excuse me?
I do. My parents are watching. They're sitting on a rainbow. I'm a half man, half giraffe, and I'm dressed like Brett Favre. What does that mean?
I don't know.
Yeah, talking about it gets me pretty hot, though. Uh-oh, there it is. His pants just got tighter. I'm a vampire. Can you believe that? Does that make me more mysterious and attractive?
What?
Uh-oh, watch yourself. We don't want to get hit by a car.
Oh.
My brother did that once. He can't talk now.
Oh, my God, that's serious.
Yeah, pretty serious. Are we getting serious? I think so. How many kids do I want? 5? 11? First meal. Here we go.
That was rude.
This is on you. So much time is flying by.
Yeah.
You're very funny.
Oh, thank you.
Does anybody ever tell you that?
Yeah.
Well, you're not that funny, so don't worry about it.
That's interesting.
Not a big fan of Sam's anymore. But now you know everything about me. I feel like I'm opening up so much. God, I'm scared. This thing's moving so fast.
Yeah.
Oh, wow. I haven't cried like this in a long time. Are these tears? Uh-oh, here we are. Front door. Big first kiss moment.
Oh.
This is just moving a little too quick for me. You're a great kid.
Crypto is better when it's tasty. The Tasty Crypto Show, hosted by me, Ryan Grace, and Frank Caberna, will help traders of all levels learn DeFi trading. We'll provide our insights on altcoins, crypto industry news, and blockchain education. And we'll have you swapping, staking, and trading using derivatives in no time, all using the Tasty Crypto Wallet app. So don't fork up your chance to become a crypto master. Watch Tasty Crypto only on Tasty Live.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
At Tasty Live, we live and breathe the markets. But when the live show's over, are we out of breath? If you want to inhale the latest breaking market news, we've got you covered. The Tasty Live research team and on-air personalities post refreshing content updated daily covering earnings, economic reports, trade ideas, and much more. If you want a breath of fresh air and not stale takes, visit the News and Insights tab at tastylive.com.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com.
Crypto is better when it's tasty. The Tasty Crypto Show, hosted by me, Ryan Grace, and Frank Caberna, will help traders of all levels learn DeFi trading. We'll provide our insights on altcoins, crypto industry news, and blockchain education. And we'll have you swapping, staking, and trading using derivatives in no time, all using the Tasty Crypto Wallet app. So don't fork up your chance to become a crypto master. Watch Tasty Crypto only on Tasty Live.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
At Tasty Live, we live and breathe the markets. But when the live show's over, are we out of breath? If you want to inhale the latest breaking market news, we've got you covered. The Tasty Live research team and on-air personalities post refreshing content updated daily covering earnings, economic reports, trade ideas, and much more. If you want a breath of fresh air and not stale takes, visit the News and Insights tab at tastylive.com.
If you missed the live show, here's our cherry on top yearly recap.
So, we're doing the show on Friday, and the bat, he's doing the show in the morning, then he's going away afterwards, right?
Yeah.
He's all packing up the car, he's doing his stuff.
RV.
Packing up the
Packed up the RV for a 6 to 8 day trip. We're supposed to be there about
4 days.
8 hours.
I bet him $20, and I said, you'll be in a hotel by either the first night or second night.
And then I vociferously stood up for you.
Of course you did. You stood up because that was the smart move.
I appreciate you. You're
yeah.
Saturday morning, I look at my phone and it says Venmo $20.
I almost had to pay him $40 because there was a little stipulation. If I didn't sleep there one night at all, I'd have to double the bet. I almost had to send him $40.
What happened?
See what happened?
Here, what happened was
we're driving up there. It's absolutely beautiful. It's like sunny as can be.
You were tweeting pictures.
Oh, yeah, it was beautiful. It was
on
beautiful.
Instagram, you're like, I'm here in the woods.
Absolutely beautiful. Absolutely beautiful.
Amazing.
It was gorgeous. We were gonna make a slight right-hand turn. We got about 10 miles to go, and up ahead there's like this dark cloud, and it's raining. It started getting muddy, and dogs are getting all muddy. Wife's having a little problem. Bugs are everywhere from the rain. And I realized at that moment that my wife was not a camping gal.
That's a surprise.
So at 6 o'clock in the morning, I pulled everything out, closed everything up, shoved everything underneath, and I was home. We actually left because we did the show at 10 o'clock in the morning. Let's say we left at 10:30. I was home at 10 o'clock in the morning the next day. Look at him.
You were just
jumped in my pool, looked back at my house, and I said, why would I ever leave? Why?
He was going to go fishing, catch muskies.
He's hurt on this one.
Muskies.
Full scoop by checking out the archives at tastylive.com.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
What is going on, everybody, and welcome back after an extremely volatile market after hours yesterday. We got some things to get into, but before we do that, Gus, how are we doing, brother? We're holding up?
Yeah, holding up is about how I would put it. It was a rough day for me today, rough day for everybody, but I'm just doing what I did last time. I thought we found the bottom and picking up some shares, and just gonna wait it out. Playing pretty risk averse, but I'm just choosing to view this as a discount, and sometimes you gotta take one on the chin. That's what happened today. I think what differentiates good traders from great traders is your ability to tolerate losses, especially in times of market-wide downturn. I mean, it's like, think about what makes somebody a badass. Like when you think about a badass trader, what makes them that way? It's that they're like, I lost 20K, whatever, I'll get it back. 20K this morning, nothing to a guy like me. So that's what I'm trying to do. I'm crying internally though. It's a mixed bag.
It's like that meme. It's that meme, but it really is being able to be calm and make thoughtful decisions through chaos, especially during now. I think a 1,500 point move to the downside in an hour was one of the quickest moves to the downside I think I've ever seen. From the last years, I remember watching March of 2020 a little bit. I know that happened very quickly. The recovery was even quicker, but 1,500 points in just an hour is pretty crazy. But I'm glad everybody else is holding up with us.
I was thinking we were going to get a circuit breaker like this morning. I was like, all right, are we going to have to halt this thing? But fortunately we didn't get that far.
Yeah. We even made lower lows today. Just as a cherry on top. So I know tomorrow we have NFP, some type those binary events, which will bring more volatility to the market. So I'm interested to see where volatility is going to be. I know yesterday Dr. Jim was making a joke. Watch VIX open up like 0.47% after the move today. And I thought that was funny. But we're getting more volatility. I'm excited for the segment we're going to get into today. I hope everybody else is doing well, been managing their positions. I think a move like yesterday definitely is going to make you make you think deeply about how you're going to manage some of these positions. I know I got out of some of mine, but we'll circle back around to that. But today, risk and reward, the 7 deadly stocks. What is the 7 deadly stocks? What does that even mean, guys?
It's like a play on the 7 deadly sins. I was throwing it around like greed and lust and all that good stuff.
I love it.
Yeah. Anyway, our segment for today, we're going to be talking about the 7 deadly stocks. This is 7 stocks you absolutely should not own for all intents and purposes, and this is reinforced by Wall Street. This is not just based on our thinking, where we have nice quotes from Wall Street to reinforce all of these opinions. There's a lot of stocks that analysts have been shouting about for
some years now that people shouldn't be buying, and lots of people still do, especially the last one on this list I found to be incredibly surprising. So yeah, excited to get into it.
I love it. So these are the stocks analysts consistently say to avoid: missed earnings, weak growth, the whole list. So let's get into it.
Let's do it.
Macy's number one. Throwback to Macy's. It reminds me of JCPenney. That's what I think of right away. But we got Macy's as number one, Gus.
Yeah, Macy's number one. It's Macy's has been struggling. They got macro struggles adapting to the world of e-commerce. First bullet point, and that's a big one. You see, companies that have successfully adapted, like a Walmart. They have successfully adapted to the world of e-commerce. You have to be able to hang with Amazon. Basically, is the way that the world works now. If you can't hang with Amazon, you're going to fall by the wayside. In the micro, store closures, declining revenue. They have fewer and fewer stores every year these days. They also, and this was hilarious and didn't get talked about enough, I don't think. In November 2024, they noticed just suddenly that $132 million to $154 million in delivery expenses had been intentionally concealed. It was one employee who acted alone, and they weren't able to find any evidence of personal or financial gain for that employee. And so Macy's just threw their hands in the air and said, we don't know why he was doing this. And I think that man was a scapegoat, because there's no way $150 million goes unreported. And it's just one individual acting alone who gained nothing from it. So found that to be quite odd. Last point, when's the last time you went to Macy's? You yourself. I don't know the last time I walked into Macy's. That's a great question.
Yeah.
Like, it's been a while. It used to be a thing when I was a kid, back to school shopping. Like, Macy's is one of the places you would get some clothes. But yeah, I don't know the last time I went to Macy's.
It's been a while. I know those brick and mortar stores have been struggling for a while. I went to a JCPenney's. I know slightly off of Macy's, but I think it's its cousin. I went to a JCPenney, I think maybe four. Yeah, Kohl's is definitely in there with Sears, but Sears went bye-bye. But JCPenney, I remember going in there, it was just completely dead. I do remember for my homecoming dance in high school, I remember picking up my stuff from JCPenney's. Like, I remember JCPenney's being all reliable, getting some dress pants, some nice shoes, a dress button-up shirt, whatever it is, but it's in the same boat as Macy's. You mentioned Amazon and Walmart. Do you think those, I know we're not talking about those right now, but quickly, Macy's struggled to adapt to the e-commerce space, right? And it's almost like Walmart's doing a great job of adapting to the e-commerce space. It almost feels like those companies are now at the point where they're almost too big to fail. It's like, as long as they're adapting with the times, they're going to see success. But it was funny when you mentioned that. That's what I thought of. But been a while since we've been to Macy's, to answer your first question, Gus.
Yeah, I mean, and that's the thing, is it's all just about staying with the times. Everybody is too big to fail until the times catch up to them. AOL was too big to fail at one point, but you got to be able to think quick on your feet. Macy's hasn't done a great job of it. Next slide here, we have, this is TD Cowen has had this thing rated at market perform. Also, sidebar, we have got to standardize the rating system. Analyst companies of the world, if you can hear me, analyst companies of the world, fix this system. We need one consistent set of ratings, because I'm tired of market perform and neutral and market average. You guys are just pulling things out to say the same thing. Anyway, TD Cowen has had this rated as market perform for the last year, lowered their price target multiple times in that time frame. They have concerns about the broader retail environment, which, as you mentioned, Errol, retail stores are struggling bad right now and have been for some time, ever since the advent of Amazon, full circle. JP Morgan downgraded it to neutral last month. They lowered the price target by over 25% last month, cited highly mixed performance in 2024. I think that's a kind way to say they kind of sucked in 2024. And Citi also downgraded and slashed their price target by more than 25% last month. They cited decelerating comparable sales, issues with navigating external uncertainties. And by navigating external uncertainties, they mean getting on the internet. And decelerating comparable sales, they're slowing down. This is a bad look for Macy's. This is a stock that I've been bearish on for I don't know how long. They just keep on closing these things. And as we're going to get into with a lot of these companies, there's just better things you could own. There's just better things that you could own in this exact same retail, even if you want to get into the retail clothing space specifically. So Macy's is our first one.
Yeah. All right, second one, we have Kraft Heinz, a little bit different, kind of in the same ballpark as those companies you kind of known of kind of growing up, that you grew up with. This has a market cap of $36.3 billion. Year-to-date performance really not as bad in comparison to the rest of the options that we have here, Gus, but a negative 2.3% on the year. Things could be worse. Again, Tesla had their advantage. They had the run up before the massive downside, so they had a little bit of a head start, but crap down, a couple percent on the year, bogged down by poor retail momentum in the U.S., consistently missed growth targets in 2024. After looking at some of these other underlying, it's funny how many stocks flew under the radar that was really struggling in 2024. But just the market saturation increasing for all products. I went to Publix the other day and I got a ketchup, and it was Kraft Heinz, and it was like a habanero ketchup, but it was on sale. So I was like, okay. I went here last week, it wasn't on sale. And then I think I had seen it at Walmart, and it was on sale at Walmart. And so I was like, okay, maybe they're struggling a little bit, especially when they're getting all crafty with the sauces that they have. Like they have a jalapeno ketchup one, a habanero one, a pickle ketchup one. I'm like, okay, they're getting creative. They're straying off from what they usually do. Maybe they're taking a little bit of a hit.
They keep trying to do these horrible collabs with like Lay's potato chips as well. They roll out ranch and ketchup flavored potato chips, and it's like,
I see the vision.
I see the vision, but like, I see the vision. We could do better. I feel like. Anyway, sorry, go on.
Yeah. No, completely. But we got some downgrades. We got Goldman Sachs rated a sell for over a year, lowered price targets in October in 2024. Again, 2024. Piper Sandler, overweight ratings for 6 months, needs for visibility, confidence, and better U.S. retail momentum. So that's slow and just U.S. retail momentum. And then we got Mizzou. I hope I don't pronounce that wrong, but Mizzou downgraded in February on growth concerns, cited weak historical execution off trend portfolio, which is challenged for growth. So it's just really looking like we've seen these slowdowns back in 2024, and maybe we see that continue into 2025, especially for Kraft Heinz. Never traded I don't have that in my portfolio either. Have you traded this underlying, Gus?
No, actually learned this was, well, I shouldn't say learned this was a public company, but it was brought to my attention once again that this is a public company for the first time as I was doing research for this project. I didn't know. All right,
number 3.
People might not like this one. On Semiconductor, market cap 19.83 billion. Really poor YTD performance, and also I should add that these slides were made yesterday, so that's before all of the craziness that happened today. These numbers would all be worse. But year-to-date performance, they're down 35.92%. On semi is, and I'm not going to say semiconductors are a bubble, but it is a slightly oversaturated space right now. And this is just one of those companies that would be easy to see getting squeezed out by the bigger players in this market. They have declining demand in key markets, their 2 key markets being automotive and industrial. Their manufacturing is done in China. The tariffs that just came out are going to hurt. And they're consistently losing market share in the semiconductor space, as I alluded to there at the beginning. The TSMs of the world are going to squeeze out these smaller companies like onsemi more than likely, and that's what's been happening, and that's why they have the declining demand in key markets, is because automakers are choosing to switch to larger companies that can manufacture these things quicker. We can jump over to some analyst stuff here.
Yeah,
we have CFRA sell rating. Good rating, by the way. Love this rating system. Sell. Good. Anyway, sell rating since July 2024. They cite their poor price to earnings ratio, concerns about competition for silicon carbide, which is what they use to make these things. It was news to me. Perhaps it's news to you. I'm not an engineer. Morgan Stanley, underweight rating, which is bad, by the way. You feel like underweight means like it should be bought up more? Wrong. Underweight is bad. Rating since July 2024. Concerns with their ability to compete in the semiconductor space, essentially saying the same thing a different way. There is increasing competition, increasing market saturation. And Truist Securities, who I am brand aware of because of their sponsorship of the Atlanta Braves baseball stadium. So good on you, Truist. Downgraded from buy to hold in February. They also slashed their price target by almost 30%. They cited deteriorating demand trends in the automotive market, so they're getting more specific. onsemi isn't doing as well with automotive anymore, but really, market-wide, on semiconductor is having problems. They're getting squeezed out. This market is becoming more saturated as more and more people. It's a gold rush for semiconductors right now. And there are simply better players. And once again, if you want to own a semiconductor stock, there are just better ones to own. So onsemi, it definitely makes the list to avoid in 2025 for me.
I know onsemi is down 35, almost 36% on the year. Granted, they had an insane year or an insane run in 2024, all these semiconductor stocks. So adding a little bit of context, it's not as bad as it looks. They started pulling back or the bubble may have popped, if you will, if you wanted to consider that a bubble, as the year started. So we'll see how these semiconductors perform. But we got good old GoPro. GoPro market cap of $102 million year-to-date performance, getting absolute slaughtered right now, almost negative 40% on the year. It's failed to diversify products, market saturation constantly increasing, consistently declining demand, and missed multiple sales targets in 2024. 2024 seems to be a very common theme of across all these other underlying. So I know with GoPro, the consistently declining demand, number one, it sounds like consumer sentiment has been down overall. And then on top of that, there's so many more products like a GoPro that's more cost efficient. And I wonder if they're taking a hit in that area too. GoPro has like the name of the like official GoPro. People use these type of cameras for these type of things. And there's so many, I don't want to call them knockoffs, but there's so many other rebrands of things like GoPro for half the price, and maybe they're getting the same output from them. But it's not too much of a shocker to see GoPro on this. But I think seeing it down 40% year to date is a bit of a surprise.
Yeah, and GoPro, it's you make a good point. I mean, it's almost like a Kleenex or Velcro situation where GoPro has become the catch-all term for these action cameras. And so we don't really realize that the market saturation is increasing because you assume that it's a GoPro whenever you see these videos, but it is. And yeah, they're getting squeezed out.
And again, it reminds me of like Band-Aid for a second. Like Band-Aid is the brand itself, and there's so many different brands of Band-Aid, and they have the name Band-Aid. Exactly. So that's kind of what it reminds me of when you bring that up again. Now we got Morgan Stanley equal weight and a sell. I love the buy rate, or I love the buy and sell ratings, like you were mentioning. Very straightforward and simple way put. But sell ratings for the last 18 months cite concerns about uncertain outlook. Oppenheimer underperformed ratings for the last 2 years. Skepticism about GoPro's ability to diversify its product lineup and return to growth. As for GoPro, what are their other popular products? Do you have any idea of that? I'm sure they have
accessories.
Like I mean, straps, accessories.
Yeah, you have to. It is like a whole thing. You got to buy like the kit for whatever you're going to be using the GoPro for, and you got to get a waterproof case if you're going to go in the water and all that good stuff. But I don't know that they have another actual high value product.
Okay, I'm just curious. I just wonder, like, for example, have you seen those motorcycle videos where they're recording themselves off like a 360 camera that sticks out with an arm?
Yeah.
Like I was also curious. I wonder if they create anything like that either. But outside of accessories, I don't really know what else main products, like you mentioned, they're selling. But either way, Wedbush Securities has a neutral outlook, and a sell ratings for over a year concerned no sales growth targets will be hit in 2025. That's a pretty bold statement. Concerned no sales growth targets will be hit in 2025. So again, very common thing across 2024 this year. It seems like a lot of these underlyings might be taking a hit, but GoPro is not spared in the destruction of some of these underlyings. But we got GoPro for the third one, Gus.
Yeah, Pfizer. Pfizer's our next one. People may be surprised to see this one on the list, but I'm coming with backing. Pfizer, again, is just another one of these where if you want a pharma stock, I can name 3 pharma stocks that would be better to buy right now. Like I can certainly name 2, Novo Nordisk and Eli Lilly. Pfizer is just sort of in a weird place in the market right now. They were really thriving on their COVID-19 products. Obviously, that was when the name Pfizer kind of became a household name, was when they were rolling out the vaccine. I think that they were first to market with the vaccine, if I'm not mistaken. There's increasing competition in the pharmaceutical industry, and most critically, they're very late to the market for weight loss drugs. They do not have a weight loss drug in the market right now, and I've been making this comparison for a while, but weight loss drugs are the AI of pharmaceuticals. If you're a tech company, you can say AI and you will get a price bump, and if you are a pharmaceutical company, you can say GLP-1 or semaglutide, I don't know how to pronounce it, and you will get a price bump. And Pfizer has not done a good job of that. Now, to their credit, they do have a weight loss drug currently under development. It's going to be an oral one, so no injections required, and they're hopeful to have it released by the end of this year. But that's a ways away, and that's a lot of time for these other companies, the Wegovy's and Ozempics of the world, to continue diversifying their product line and work on getting their supply chain in place while Pfizer is still working on developing the product in the first place. Additionally, Trump administration, RFK, has made lots and lots of anti-big pharma claims, and it seems that he's really going to try to crack down on big pharma, whether that means more taxes, less subsidies for research, whatever it may be. It's probably going to be a bad presidential administration as far as pharma goes. Again, ratings here pretty similar to what we've been saying. TD Cohen, market perform. UBS Group, neutral. Citi lowered their price target last last month. Cautious outlook in 2025. Across the table, analysts are not high on Pfizer, and for good reason. I think that they could be a company that falls by the wayside in this space race in pharmaceuticals right now. So Pfizer's our fourth one.
Yep. I think it's interesting how they're marketing as like you can take it orally now. I think people getting stick with something like needles, if you can find an alternative to that, I think that's a kind of a very unique angle that they're coming at it with. Yeah. Absolutely. Yeah, exactly. Definitely. Next, we have Lyft. I can't say this is so much of a surprise, and we're going to go over a bullet point that I believe we've touched on over the last couple months, but the market capitalization of Lyft is $5 billion. Year-to-date performance down negative 13% on the year. It is a cheaper underlying, so down 13% is a hefty hit that Lyft is taking year-to-date. But Bank of America downgraded Lyft 2 levels from buy to underperform. Analysts cited Waymo's expanding presence as a direct threat to Lyft's long-term viability. I thought that was really interesting. I know Uber is doing a little bit more when it comes down to the robo-taxis. I'm using that term loosely because I know robo-taxis might go more with a specific industry that might be using them, but growth in autonomous ride-hailing is outpacing Lyft's traditional model. I'm curious to see if they're going to make a mistake of adapting and adjusting and transitioning in a timely manner, or if Lyft is going to get hit when it comes to those things in the industry. Q1 guidance was weak, and revenue growth is slowly dramatically. Despite being a household name, Lyft is losing market share to Uber, not a surprise, and struggling with profitability, not a surprise again. I was bringing up to Dr. Jim again a couple months ago. I was kind of surprised about how long Lyft was able to stay in the game, especially with Uber taking up so much of the market share. But then again, I had to remind myself, some companies just want a piece of the pie. You don't really got to be the big dog, the number one in that space to really see any type of success. But I've just been surprised with the domination of Uber kind of turning into one of those names we were just talking about, right? It's like you can get a Lyft, like we call a car picking us up an Uber just naturally, and someone might be like, oh, I actually use Lyft, but we use that term interchangeably again. But Bank of America Securities downgraded Lyft from a buy to underperform, reducing the price target from $17.50 to $10.50, almost chopping it in half. The downgrade was due to concerns over Lyft's slow progress in autonomous vehicle technology and increasing competition from companies like Waymo and Tesla. I think if you have Tesla in your back pocket when it comes down to electric vehicles, number one, and self-driving, and if you're a service like Uber or Lyft and you can have Tesla in your back pocket, they might push you over the edge to be leading in that space too. So I think Lyft is definitely at a disadvantage because they're not going to have any of those partnerships on lock. So we'll see how the space develops overall. But Lyft is taking a beating.
Yeah, I'll say not as a share, but as a company, I am a Lyft user. I use Lyft pretty much exclusively. I've come to find that it is just cheaper than Uber pretty much everywhere I go for the same experience. So as an economist, if I find a cheaper, perfect substitute, I'm going to use it. But I'm not surprised to hear these things. And the brand recognition for Lyft is just so bad, as you mentioned. I noticed walking out of the airport the other day in some city, I've been doing a lot of traveling recently, that the lines that I was following to go to my Lyft all just say Uber pickup. Big Uber logo, big stickers on the floor, Uber pickup, and no one ever is using Lyft in that sort of context, even though that's what I was going to get in. So that's a problem facing them as well, I think.
I mean, and you know what's so funny? If we were to think about right before we get into our last one, I know we got a couple minutes left, but you know what is so funny? Uber, before Uber came about, like Uber doesn't sound like an action word or like a Uber, Lyft, if we're speaking 10, 15 years ago, sounds like, right? It's a little bit more on brand for what type of service
people have been saying, I'm going to go catch my Lyft forever. My Lyft is here. Yeah.
Right.
And I agree. Right. It should be better.
Right. But anyways, Uber definitely dominating in the long run. But the last one we got here is Nike, Gus. It's been beaten down year to date, but we definitely got some downgrades on it. But we got Nike. What is this one?
Nike. These tariffs, you could obviously go on and on about tariffs on a day like today, but Nike is getting hit bad by the Vietnam tariffs. Actually, I didn't realize that Nike did as much production in Vietnam as they do, but that is what's hurting them the most. 30% of manufacturing based in China as well, under heavier tariff pressure, as I mentioned with on semi. If you're centered in China right now, you're not doing so well in the market today, I assure you that. Slower demand growth in North America and Europe, I would assume that is likely due to increasing substitutes entering the market. I'll float this one. All of these girls wearing Hakas and on clouds right now were wearing Air Forces 5 years ago, and they're not anymore, which is one very niche example. But there are just more substitutes entering the market, and Nike doesn't have the appeal that they once did, maybe 10, 20 years ago, as being the clear best option if you're looking for shoes or clothes or whatever. And they're also pivoting to DTC, which is not offsetting wholesaler weakness. That's always going to create problems for you. I'm personally a DTC bull in general. Nike has not done a particularly great job with this transition. But Nike struggling. 32 Wall Street analysts. Oh, you got the consensus. Let's go, Errol. Based 32 Wall Street analysts over the last 12 months. Moderate buy, 14 hold, 18 buy. And I would assume that people may be pivoting on that stance a little bit more like today, now, after these new things have come out. I would assume that we will see some buys switch to holds. So Nike, weak one, don't want it in your portfolio 2025 either.
Yeah, no, we're coming to a close. I know I was thinking about it the other day. I had a conversation around, things like Lulu, Alo, like the aesthetics with their merchandise being posted on social media. And it really seems like they're grabbing a chokehold in the fitness industry. And I remember Nike Pros were so popular. Like those back in the day, 5 to 10 years ago, were like the A1 fitness gear that you can find. And now I see a lot of consumers choosing branding that is a little bit more simplistic, like an Aloe, right? The fonts and the branding isn't as aggressive on some of the fitness products.
All of them.
Right, absolutely. They're clean. Yeah, clean and simple. And it sounds like, Nike Pros and the Nike, like all of those fitness.
Nike Elite socks, bro.
The fitness
Nike Elite socks in 2014,
don't get me with Sperry's? With the Sperry's.
Nike, the double layer Nike Elite socks, the $23 pair with the Sperry's. Oh, yeah, that was heat. That was heat in 2014.
With the cargo shorts?
Yeah, bro. Pop some Chief Keef on the radio and throw on the Nike Elites, bro.
You're chilling. You're chilling, bro. Driving down memory lane right now. But no, I love it. We'll see how Nike performs for the rest of the year. Probably going to still take a hit. I know we got a lot of uncertainty still with all these tariffs, but we'll see what NFP brings tomorrow. We are wrapping. Anything to add before we head out of here today, guys?
Yeah, no, nothing. Sorry for the little shorter show, guys. Today we had some technical difficulties, but this chat has been making me laugh this whole time. We love you guys. Mike, Luis, Alpine, CM, Catan, Laid Back Trader. Have you met Terrible Trader? Two different people. Anyway, we love you guys. Appreciate you guys being here. I am reading all the chat. I just didn't. We had no time to defer today, but we appreciate you.
Absolutely. Well, thanks for taking the time to be here with us today. We'll see how some of these underlyings perform headed into the rest of the year and how the market digests all this tariff news. We got NFP coming tomorrow, so be sure to stay vigilant for that, and we'll catch you guys next time. Peace.
If you missed the live show, here's our cherry on top weekly recap.
I had what you call the hot girls dinner.
Oh, you had girl dinner.
Cheese plate?
No.
Popcorn and wine?
Crackers?
I went snorkeling.
You went snorkeling?
But I said the last time I went snorkeling.
And the fact that you've ever been snorkeling is pretty amazing.
That it also implies a future time that you will be snorkeling, right? Not because you didn't say the only time I went snorkeling. You said the last.
The last time. It kind of has the implication.
What did you say? The fact that I've ever been snorkeling is amazing?
Yeah.
Why?
Because she studies physics and it's not supposed to work.
It just doesn't, yeah.
Wait, you're going to Vegas?
I am going to Vegas, yeah.
Ooh, for what? For just funsies?
For my birthday.
Oh, wait, I didn't know it was your birthday this weekend?
Yeah.
Oh, happy birthday.
There you go.
I didn't know you were an Aries.
I am an Aries.
Yeah, that kind of tracks.
Something. What is your sign?
I'm an Aquarius.
Aquarius?
I'm an Aquarius, yeah. Tom's a Pisces.
Pisces.
Yeah.
That makes a lot of sense.
It does. Yeah. It really does.
That kind of tracks.
I don't even know what that means. Sure. Whatever.
I think it means you like fish.
What happened, girl, during last call?
I lost my
You want to talk about it?
I lost my beret.
You didn't lose it.
I found it.
So you got...
I'm thinking of getting rid of it.
Oh, new look?
I'm thinking of the new look.
You should do a faux hawk.
Oh.
What is
I think you nailed it, Vanessa. I don't know.
No. Cornrows.
I could see rocking some cornrows.
Yes, cornrows.
I think you should go to Flavortown and just get the Guy Fieri spikes.
Boom. Platinum tips.
Platinum, yep.
Is it true? Did you skip the beret yesterday?
on the close.
Oh, it looked like a decrepit old grandmother. It was so gross.
It's like that old monster from Tales from the Crypt.
Get the full scoop by checking out the archives at tastylive.com.
You hear it all the time. Spoos up or spoos down. What exactly does that mean? Spoos is a slang term for the S&P 500, specifically the S&P 500 futures contract /ES. It's the world's most liquid asset. In the S&P 500, billions and billions of dollars trade hands each day. The S&P 500 represents the top US stocks, all in one basket, traded through one contract. The S&P 500's movement day to day gives you a good overview of the market as a whole and what it's doing.
One of the things that was most intriguing about the financial space to us is just that there wasn't a lot of vision. There wasn't a lot of innovation. After almost 20 years of open outcry standing in the pit trading, I felt like all the markets were moving to electronic trading. I saw the writing on the wall, and I wanted to be first. Building the best technology in the world for traders was one of the coolest things anybody could ever do. I loved every second of it. Thinkorswim will always be my baby, but this one, it's different. We built ours literally from scratch. It's a much thinner, it's a faster, it's a slicker application. Everything's on one page. So you're always looking at the core page and then bouncing around from there to get to whatever you want to get to. We're here to support whatever you're looking to do. We have the tools that you need to be a successful trader.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
Oh, yeah. It's Thursday, the day after Liberation Day, April 3rd, a little after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world, and good God, did they give us some incentives to chew on, and good God, do we have a new world order trying to govern? More on that in just a bit. We should probably say what's up to the people. Shout out to everybody watching on tastylive.com, as well as all you degenerates who can't take your eyes off the screen and you're watching inside the Tasty Trade mobile or desktop application. If you don't already have both, go get them. But if you want to be part of Bing, this little guy, this chat box in the middle of your screen, there's only one place to do it, and that's over on evil Google YouTube. So head on over to Tasty Live's YouTube channel, find the chat, and start bashing your metacarpals, your phalanges, your skull, anything, any nub will do. And type in random ass characters, and we can spoof the Google algorithm into getting us in front of as many people as possible. I would shout out the whole chat, but I'm contractually obligated to say something that might be interpreted as something of substance, so I will not. I'll just tip my cap to all of you. We've got a special guest on this Thursday following Liberation Day. The one, the only, the incomparable Mr. Josh Fabian. Josh, how are you, man?
What's going on? So you bring me out when hell and damnation take over? Like, how did you get through all of it, Josh?
I'm like, this is the end, so we might as well throw this guy a bone, give him some more airtime.
Everybody's drinking at this point. Everybody's looking for salvation. Like, yeah, I'll bring Josh on now.
Yeah, this is an intervention. Josh, have you accepted Jesus Christ as your Lord and Savior?
I am in trouble.
What's going on, everybody? I wanted to have you on, Josh. A lot of people, I'm sure, know you, but just in case they don't, you're a producer here. You really come up with a lot of the topics that drive a lot of some of the outperforming segments here at Tasty. Some of the fan favorite segments, you come up with the topics that Tom and I will talk about on Hear Me Out. You come up with the topics for truth or skepticism. You do a lot more, but I'm just saying, I want people to know, if you get upset at the content or the political leanings in one way, shape, or another, this is the guy to direct all your anger to.
I was about to thank you for the compliment, but at the same time, I was reading. I'm like, nah, there's something coming.
Come on, you know me better than that, man. So I thought, given you and I have very spirited discussions in the text message, and I find myself often trying to help you understand the world's events as you're clearly confused. So I thought,
trying to save my soul.
I'm just kidding. Josh is a really smart guy. We have somewhat differing opinions at some ways, and I thought it would be an interesting discussion to have on a post-Liberation Day. First and foremost, man, I'll just ask you a super general question. What did you think about what you would hear this week and what you would see from markets versus what you ended up hearing and what you ended up seeing from markets?
I didn't have a very strong opinion as to what we would hear. I know that the 9 and 10% number was being kicked around quite a bit for the tariffs. So I guess, like everybody else, that's sort of what I was assuming. But the fact that there were no leaks on this had me guessing or questioning whether or not that 9-10% was legit. The market reaction, quite honestly, didn't surprise me in the least. I've been holding some short delta. I think that the extent of it was maybe a little surprising. But the thing that, if there is one thing about it that surprised me, is that it still felt orderly up until today. Like we've seen this week, this kind of building and building, but the VIX hadn't really done much of anything. But today you finally got some panic selling, I think. I mean, you look at I just got the SIBO's numbers, they were up 33%. So, I mean, you had
volumes on the SIBO.
Yeah, the volume was up 30. Yeah, sorry. So I was expecting selling. I didn't have like a number in mind how far down we would go, but I wasn't surprised to see the selling. Were you?
Yes, a bit. I'll explain sort of my thinking. My thinking was very rarely do these things. I don't know. I sort of thought the 9-10% baseline was already in the price. So that like flat tax, that was already in the price, and it had been whispered about prior to the announcement. I think there were probably two things that were pretty shocking. I think the way in which we calculated other people's tariffs on us for then us to put on reciprocal tariffs, I think that was disingenuous. We basically took our trade deficit to that country and divided it by total imports, which sort of assumes that the entirety of a trade deficit to a country is brought about by tariffs or trade barriers. And that's probably a disingenuous interpretation. So I think I was a little bit surprised about that. The market probably was too. And I think I was surprised at, we're playing a poker game, right? So you don't want to come out light, because then the market's not going to take you serious. Your trading partners aren't going to take you serious because you made this big deal about April 2nd. And if you come out light, the market's going to go, okay, this guy's a joke. And then perhaps you got to do something even worse later. And it's just it continues this on again, off again narrative. So I didn't think I didn't think we'd see something light. But the hard part is, okay, do you do your worst case scenario first? And the reason that becomes a really difficult position in my mind is if you go with your worst case scenario first, you have the upper hand in terms of shock and awe. He's clearly following like this Nixonian madman strategy. He wants to play with foreign policy. It suited Nixon. It seems like he's borrowing some of that. And likely you put max pressure on your trading partners to come to the table and negotiate. But here's the problem. It's a massive, massive gamble. It's a huge gamble because if you don't get your desired output, if you do not get your trade partners coming to the table and negotiating down their tariffs or manufacturing or their investment, if you do not get your desired output, what then? We are now stuck at what Scott Besson has called the ceiling of where we wanted these tariffs to be, with no real catalyst to bring them down. And I think you've seen, so the biggest question once these get announced, coin flip, right? Coin flip that people come to the table and they negotiate and these get walked down. Coin flip that you start to see people like Emmanuel Macron, who took a real hard line, seemingly to the public, a hard line stance on this today. And I think that so it becomes really difficult to bet on these outcomes here. And I think you see in that world, I think you see less and less people that want to bet on the right side of the distribution clearly. People are like, look, this might work, but it's a huge gamble. And basically in the next 30 to 60 days, you got to get all your trading partners to come to the table and start wanting to negotiate things and de-escalating. And I'm not so sure that that's the outcome that happens. And you probably get a mix, right? You're probably going to get over the next couple of weeks, you're going to get some trading partners that capitulate, that come to the table, and you're going to get others that escalate the situation. And how do you mix that soup up into a distribution curve and try to bet on an outcome? And I think, I was a bit surprised that he took the max pain point and didn't really give himself a level to escalate. Because imagine, let's say you get Japan, China, Korea, or Europe partners with somebody in Latin America, whatever, and you get retaliation, which it seems like we're going to at some level. Mm-hmm. They're going to come back over the top. So what was supposed to be a ceiling rate could actually,
it's a starting point.
It's a starting point that ends up going tit for tat. And so I think people see that part of it and they go, yeah, we might have lower rates in the future. We might have quantitative tightening that's going to go away. We might have quantitative easing, but it's just too much risk to hold on from now until that point. Even if that point is 2 months or 3 months from now, it's too much risk for me to hold on through that volatility. So in hindsight, can I say I'm surprised? No. But if I'm being honest with myself and the viewers, I expected this to be a little bit more difficult. I expected the announcement to come, stocks to rally, people to get confused, then we puke. And now you can't make heads or tails of why the market rallied and why the market puked. When we just puke 5 or 6%, everyone goes, okay, this was the catalyst. This is the narrative. This is not complicated anymore. And usually I tend to find that doesn't happen in markets. It's a long-winded way of sort of explaining what I see happening here. Could I ask? Go ahead.
Yeah, no, go ahead. Ask your question.
And feel free, man. I want to ask you some things I know the answer to, some things I don't. And feel free, this could be a two-way conversation. I think we're going to have Ilya and Chris on it. It's a bit more one way because they only come on once a week. I'm scratching out their brain. In this case, I think we tend to have interesting two-way back and forth. So do you have a personal feeling about tariffs, Josh?
I'm opposed to them. I'm opposed to tariffs. I am a believer that in free markets, and because I think once you mix tariffs in, everything gets muddy. If everything is free trade based, I understand the economic implications for that in certain industries, right? Manufacturing, if it becomes too expensive in the United States, it moves somewhere else where a dollar can be stretched further. But on the whole, I think that is a better way to go than it is to have tariff policies that are constantly in flux, that are difficult to adjust your CapEx, forecasts to accommodate. So I'm much more, tariffs get passed down to the people too. Let's just be clear about that. We end up paying for that in some way, shape, or form. And I don't see the positive side at a macro level. I do understand that it protects certain industries and can protect certain jobs, but I think it comes at the detriment of the broader economy. And what do you think about tariffs?
So let me back. I will answer your question. Let me back up and answer or ask. What are your feelings about the existing state of wealth inequality in America and whether something should be done about it? That's maybe a better way to start, and then we can go into your feelings on tariffs, whether it's the right approach, whether it's the wrong approach. But I think generally speaking, when I listen to people on, me, I've got friends on the left, I got friends on the right, I got libertarian friends. I don't judge people by political beliefs, and in fact, I probably tend to be have deeper friendships with people who have different beliefs than me, because it spurs on. I like to debate. It spurs on a lot more engaging philosophical conversation. I find that people's willingness to be open to the idea of tariffs, it stems from their sense of urgency to fix what they believe is a broken economy, to fix what they believe is sliding American primacy. And so I think there is a group in America who sort of feel like you got to take the good with the bad. Has the country experienced some downsides to globalization? Yes. Has the country experienced some upside to globalization? The answer is yes. And they would say globalization effectively is an inevitability of the competition game of capitalism that we're effectively in, and trying to undo it is like trying to go back in time and saying, let's stop using cars, let's go back to horses. And so those people would say that, the current state of the economy, it's a feature, not a bug. We're in a competition, and you're going to get a collection of resources, but there's no real sense of urgency to fix a problem. And then there's a different group who I think feel a sense of urgency to fix what is broken wealth inequality in the country, and honestly globally. So what is your feeling on that core part, core question?
It's a great question. I think that income inequality in this country is at a breaking point, quite honestly. And I think you're seeing that in politics. It's spilling over. It has become so wide. I mean, you can go back, pretty much it starts around 1980-ish when tax policies started changing. We went to more of a trickle down experiment, and you have this situation now where a very small minority owns a very large majority of assets in this country. And in fact, and you and I talked on the phone earlier today, I would say that today's action in the market, most people don't even really care because they're not in it. It's become unaffordable. So I think that, yes, we have a serious income inequality issue that needs addressing. I don't think that you can do that. I don't think that, let me rephrase that. I would not start to address that with tariffs. I think that is, I don't think that's the biggest problem. And to what you were saying about how people see these things as like, it's a quick way to fix things. If they think there's this imbalance in economies, I don't think that's what's driving these tariffs. I don't think that was Trump's thinking, and I'm going to base that on my personal conversation with him a long time ago, where he felt we were being ripped off by Japan, and it wasn't in income inequality. The guy was massively wealthy. It was like this perception of losing. Somehow we were losing. So I don't think the tariffs were designed to address the income inequality as much as in his mind it was about winning and losing. And I think if you want to address income inequality, which I think has to be done, you start with taxes. I think that's the first place you start.
Okay. What's interesting, you're the second person in a row to say that. And my only question to Chris Vecchio said it yesterday.
Oh, okay.
But my only question to most of those people was why weren't you shouting from the rooftops for the last 4 years to fix this problem through taxation? Why did Joe Biden announce a wealth tax on March of 2022 and the market puked 20% after he said he was going to take 20% from wealthy people? Mm-hmm. And then it sat on the shelf, never to be talked about again. No, it was like there's never a sense of urgency to fix the problem until there's inertia. And now that there's inertia on a solution that you don't like, now we're willing all of a sudden to start talking about all the things that nobody did anything about for 20, 30, 40, 50 years. And it got to a point where some group of people who think they're voting for populism voted in a person who would take action, and he is. And now everyone's like, no, this isn't the solution. It's this. And it's like, okay, well, maybe that's true. Maybe that is the better solution. But tell me why the elected representatives that you supported for the last three out of 4 terms, why didn't they do anything about this? They paid lip service to it, but they didn't actually do anything about it. That's number one. Let me answer your original question. What do I think about tariffs? I think I've been sort of non-committal on this, and you're the first person to ask me directly what my opinion is. So here's what I think. I like the idea of tariffs. I like the idea of using them as negotiating leverage. I do not think that they will ever be a meaningful source of revenue, but whatever, it can probably bring in a little bit of money. I think from a protectionist standpoint, I have 2 thoughts. In the short term, it tends to be protectionist, right? But I think you and I both know if you protect a company that doesn't deserve to survive, what you end up getting is atrophy. You end up getting a company that isn't productive, that isn't innovating, that's sucking off the teat of a protective tariff, that's making sure that Chinese EVs, for example, don't come in and completely disrupt our industry, which, I can get down for in some cases and but just broadly speaking, it works in the short term. Generally, in the longer term, I think we're going to have new unintended consequences of industries that lag behind. And so, yeah. And then the other part is the likely, what happens from the tariff. Most people are not just going to lay down and play dead. So what you're either going to get is somehow a politician has really good favorability in their country of origin, and they can say, okay, Donald Trump, we'll give you what you want. I'm going to keep social stability, cohesion. I'm going to keep our economy as strong as possible. Let's make a deal. Then you're going to get people that try to retaliate and escalate this even further. And then you're going to get currency manipulation. You're going to get devaluation. Mm-hmm. And I think that's a real potential risk here on the horizon, that China devalues as a response. And I don't think the administration wants a strong currency. So we're going to devalue. And the ones who lose in that are people like you and me, right? The value of our currency is going down. At the same time, people have a little bit less trust in our debt, we could be in this real sticky spot. So what do I think? I like the idea of tariffs, but the problem is when the whole world knows, like Trump 1.0, he could use tariffs, and people are kind of like, what is this? I've never seen this before. Is he serious? Is he not? I think the whole world kind of believes that he wants his best case outcome is that these are negotiating. This is for negotiation. And his best case scenario is he gets favorable trade terms and then he removes the tariffs. So if you know somebody's cards, it becomes really hard to play that hand at a world poker game. And so I like the idea, but I think the reality is we're going to end up implementing these things for longer than people expect. And I don't know what the out is that makes our hand. I don't know the spade that falls to make our flush and gives us a dice out on this. And I think that's the difficult part here. I like the idea of tariffs. Yeah. I like the inertia of trying to fix a broken problem. I like the idea. I like the idea of creating manufacturing jobs for low skilled work. I don't know. I can't tell you why, if you were going to build a bunch of factories in 2025 that has, let's say, a 3 to 5 year runway, I don't know why you wouldn't build a highly autonomous factory versus one that people sort of romanticize, like the ones in the 1980s with a bunch of union workers who are doing all these manual tasks. I don't see that happening. I do think we get a bunch of new manufacturing plants. I don't see the world in which we put back, we change the 61% labor force participation rate to 75% or something like this,
Yeah. So there's three things, and if you keep going on, I'm going to completely forget all three of them. Right now, okay. I'm struggling to hold on. First, to your comment about who I voted for and them not doing anything. Listen, for as long as I can recall, I have said that there's an income inequality issue that needs to be addressed. That the politicians didn't do anything about it, I can't control that. I can vote for somebody else, but the other options that were available to me had too many things I disagreed with. And so I completely agree that they dropped the ball on this and that we should have addressed this a long time ago. There's no question about this. And it's still going to need addressing, and tariffs isn't going to solve it. So it's still going to need addressing. So that's the first thing. The second thing, to your point about how are people going to play this, in the unintended consequences, I think that, and you're already seeing this, you're seeing some crazy geopolitical alliances starting to take place. I mean, you have, who was it? It was China, South Korea,
Japan.
In Japan, we're making, if you want to say that we're bringing the world together and creating these relationships that otherwise wouldn't have existed, I guess that's the glass half full side of it. But you are kind of you're realigning these strategic relationships. And I can't say that that's bad necessarily. And I can't say it's good. I don't know where it's going to lead. I just know that, I don't think anybody saw that. I don't think anyone had that on their bingo card.
Yeah. And so I'm down. Go ahead.
Well, the last thing is to your point about, if you're going to build a factory, and this morning you and I were talking, and the way that I view this is that, we started as an agrarian economy. The Industrial Revolution came around and farmers were going to be left behind. Then you had this technology revolution that came that started to take the jobs away from the manufacturing sector. And we've moved into, the economy, in my opinion, it evolves. And the unique aspect of the United States is that we become the tip of the spear for how things are going to evolve. So, we spearheaded the Industrial Revolution. The internet was, I'm not going to say that, we invented it, because there were places around the world that participated in that, but we were certainly at the forefront of that. And I think that we are moving into that next phase, whatever that may be, whether it's a services economy, whether it's, call it whatever you want. I don't know exactly what it will be. But if you're going to build a factory and you want to bring manufacturing jobs here, to me, that is trying to take a step backwards because it's just not an efficient use of capital. If you're going to use United States labor, that's going to cost more than you could get that labor in Vietnam. I think you're holding yourself, you're implementing almost this artificial friction. And the crappy side of that, and I admit it, the absolute crappy side of that is that people get displaced. And I think it's heartbreaking when you meet these people that get displaced because of it. But I also at the same time think that that's just the nature of evolution, of economic evolution.
Yeah.
Now tear me apart.
No, because there's an element of truth to what you're saying. I think about money as claims on future resources, and the person, like in the olden, in our earliest, we were very, primitive creatures. It's the biggest, the strongest, the most lethal gets to have the most claims on more resources. As you grow more civilized, you obey the laws of the land. It's who can acquire the most amount of claims on future resources, which is a different mechanism. It's capitalism. To win Darwinism, you have to be good at capitalism, and you don't just have to be the biggest and the strongest anymore. So there's an element to the Darwinistic aspect, the evolution that you talked about, which I think is in some way true. But then there's a flip side. The flip side is it's easy to take that approach that you just took if you're currently on the winning side of capitalism.
Sure, fair enough.
But the issue is, you, just like anybody else, as soon as you personally get disrupted, as soon as it's no longer the agrarian that gets disrupted, and farmers have a 3.5 times higher suicide rate than the general population. And now it's not just them, it's not just other, okay? And it's not just the manufacturing guy, the 60,000 factories that were closed in America in the last 50 years. It's not them anymore, and the unions go down from 20% of the workforce down to 6%. It's not them. Now it's guys like you, right? Guys like me who, with the power of technology, because technology always and everywhere is threatening the lowest skilled worker, right? It's threatening to automate. And now you're at a point where higher skilled service jobs are at risk. And I can promise you, man, if you want to play that Darwinism game, you're doing that only because there is a group below you. But as soon as you get put with that other group, which is happening right now at a rapid pace, a hollowing out of the middle class, you're not going to feel that way anymore.
That's fair to suggest that, but so wait, let me just
you're not going to be on the street, bro, begging for money going, well, I lost the game of Monopoly.
So wait, are you saying that people that can't walk are not going to inherit the earth? Is that where that's not where this is all headed?
I was told.
Your point is fair, and yes, until you are in that boat, until you are the one affected, it is much easier to say, this is how it's going to happen. So, but I also have this acceptance that at some point,
okay, I'm with you.
It will be obsolete.
I'm with you. And by the way, we'll make this a little bit actionable towards the end. And this is going to be more opinion than anything. I don't know that there's a bunch you're going to listen to this and you'd be like, okay, this is highly actionable. I can use this to trade on tomorrow. But I didn't want this to be that type of conversation anyway, Josh. I want it to be a reflection of kind of the chats that you and I have back and forth via text. I think the question then becomes like, what do you think the government's responsibility is, and what do you think society's responsibility is to the loser of the game of Monopoly that we're playing? Because in Monopoly, if you land on Park Place and somebody's got 4 hotels on it, you don't have the money to pay. It's just you can't play the game anymore. In real life, bro, the circumstance is really fucking harsh if you don't win the game. It's not just I got to watch other people play the game. It's a really harsh outcome. And so the question is, what is our responsibility as a civil society and to the least among us, to those that are ultimately not going to win the capitalism competition? And I think you are going to feel one way about it if you're on the winning side, and you're going to feel very differently if you're currently on the losing side. And I think there are things that I think about, solutions that I think about. You know, I go, why? My problem with the wealth tax is I feel it's just going to get redistributed to a consulting lobbying class in Washington, D.C., and it's not actually going to get to the people. I paid some of the highest property taxes and income taxes in all the country in Chicago, Illinois. And I'm looking around going, where the fuck is this money going? Yeah. Why are the schools, why is the school system horrific? Why is crime horrific? Why is the environmental standards? Why is our drinking water in certain neighborhoods horrific? I couldn't understand. I'm paying all this money. Where is it going? And I think so. Just taxing people more, in my personal opinion, is not going to really solve the problem. And so I think you actually have to put the money. I'm down with the wealth tax. I'm down with taking that money and going, we're 4 million. So estimates are 4 million to 7 million homes short in the United States. Mm-hmm. Why can't we have this grand plan? We implement a wealth tax. We come up with incentives for builders in this country that will get tax incentives or kickbacks to create 1 million incremental homes over the next 4 years. Okay, so it's not, we build about 1.5 million. It's 1.4 million homes a year, but we are 4 to 7 million short. So if we got 4 additional in the spare capacity, by the way, if you go look up the statistics, there are estimates that we could be building 1 to 2 million more homes per year. We're just not, for various reasons, regulation, whatever the case may be. Mm-hmm. So if we have a massive wealth tax, you put that money toward, you don't let our federal government spend it. You put it as a tax incentive for real builders to come in, hire people in the real economy, pay them living wages. So workers get paid, people go to work. We actually solve a real problem in the economy, which is a shortage of homes, and you're building affordable homes. So something at like $150,000 to $200,000 price point, where people are mortgaging their entire lives and living as indentured servants, writing these big ass mortgages to banks and rich people that keep them as indentured servants their whole lives. If we do something like this, some big grand plan that's a mix of like corporate and government cooperation, but not the government giving straight handouts to all their best friends, you create an incentive structure for builders, and you get paid only if you solve the problem. And then if you meet the mark in 4 years, the wealth tax is expired. Because we never do this as a country. We never expire something. And here's what happens. If you tell rich people that they got to pay a percentage of their wealth, do you think that government program is going to be bloated, or do you think it's going to be ultra efficient? And do you think it's going to accomplish the task in 4 years so rich people can stop paying this wealth tax? So you create an incentive to end the program. Like, I don't understand why we get caught. I mean, I'm not saying that's a great plan. I'm sure you can pick it apart. But, like, we get caught in talking about, in my personal opinion, the same dumb stuff back and forth. Should we tax more? Should we tax less? If we tax more, it disincentivizes rich people. It's like we get caught in this same stupid loop where we can't break out of it. And why don't we just think about other solutions? Where's the other camp?
100%. So my daughter, when she graduated college, was a teacher, and she taught for 2 years, and it didn't work for her, so she got out. But I was always like, I asked the question, like, why don't teachers and Ford, Chevy, one of those, if you commit to teaching for X number of years, you're going to get a car, like, work with the government to set up the system so that, teachers don't make enough money to begin with. Okay. Arguably the most important people in our society are educators. So why don't we have some sort of incentive system like you're talking about right now that, hey, you teach in a public school system, and here's the incentive for that. a car, more affordable housing. We have programs in place for veterans to get, better mortgages, so we certainly have the capacity and the understanding of how to do things like this, but why are we not applying it into places that desperately need it? I mean, you're talking about the Chicago public school system. It's a disaster because they don't attract the best of the best, because it's just such a difficult job. It doesn't pay. So why don't we have some sort of system in place, to your point, that says, hey, listen, you go work for CPS for 5 years and, your car's on us. And then you give that tax break to Ford or Chevy or whomever you want to work with. I don't care. But that type of out of the box thinking, it doesn't exist. To your point, it's always, this is what we're going to, we're going to raise taxes on the rich.
It's either raise taxes on the rich or tax cuts for the
right. But what
for
does that
everybody.
Mean?
It's the same binary stuff.
It's just exactly. It's clickbait. It's great political campaign lines.
In this world, what I think is happening is a little bit more than clickbait. I think this is total conjecture. I think there's an aspect to tariffs which is obviously negative growth, but it is more protectionist, and it's supposed to create incentives for more jobs to be onshored in America. And I think the tax cuts, in a way, are throwing a bone to corporate America. I think if you don't get the tax cuts passed, I think we're going to see a bump in unemployment anyway. The Fed expects it. We're at 4.1% unemployment. The Fed expects that to jump to 4.4% in 2025, which I don't know. It could even be light. I think the tax cuts, in a weird way, are sort of like this incentive, this bone, a bribe, if you want to call it, to corporate America. You can ease their margins, ease their profitability, which will allow them to hold employment higher than they otherwise would. Mm-hmm. If you don't get the tax cuts, I think, and you have this growth scare, I think unemployment gets a little ugly, a little scary out there for a lot of people. So I think in this weird way, there's a bunch of balancing acts going on. It's let's take down growth and implement a consumption tax. In theory, that's going to shift the demand curve. Even though it's going to shift we're going to have a one-time price shift higher. In theory, the demand is sort of already elastic there. Like, we're already losing. People can't afford to buy more expensive stuff than they are right now. So they're going to, if they haven't changed their behavior already, they're likely going to. And that's what a recession is. It's a wide-scale change in behavior of the consumer to slow down. And I think the most likely outcome here is that you cannot have cost push inflation too much. You can't push any of this stuff down to the consumer. So I think what ends up likely happening is you get a massive change in the demand curve and people shift down. So at that same time, that's negative to, if you're a CEO of a company, that's negative to your projection. But in sympathy to that, you're going to get a lower borrowing cost. So the implied curve is the Fed's going to cut by 3 times, and who knows, depending on how ugly this gets, it could be more than 3 times. Your borrowing costs go down, so that's a positive. You can go back and forth. The tax cuts are something that land on the positive side with corporate America. You can't just go upending everything and not throw bones to corporate America and think everybody's going to keep their job. It's not going to happen. Like, this is all a trade-off between capital and labor. And if you want to go hard at a strategy that you think is going to benefit labor, capital's going, hey, I got you elected, my guy. What about us? And I think that the tax cuts are basically the offset, It's the bribe. It's the payoff money.
I agree with you. And back to your initial question, how do you asked, as I'm paraphrasing, how would I fix this? I do think you have to start with fixing the tax code. I really, really, really think that is the place you have to begin. I mean, it's so skewed and so repressive that, and I'm not just talking about corporations, I'm talking about individuals as well, that you're never going to, it's a structural problem And we're never going to fix a structural problem unless we make structural changes. So, you can raise taxes, you can lower taxes, you do all these little things. Like they're kind of micro policies, right? They last as long as an administration lasts, and that's about it. But I think that you have to be able to say, hey, listen, the tax code is it's such a disaster. I mean, it's so complicated on top of that. We need to figure out a way to structure it so that it makes sense, so that we don't end up leaving people so far behind. Because, am I going to, like, when I was talking about how I might become antiquated at some point, and your point was
at some point.
Listen, the grains of grains of sand are running really thin right now.
We're way past that point of no return. You're on borrowed time, brother.
Yeah, I'm sitting here right now in so much pain. I went to the gym earlier, and I just looked at a weight, and it hurt. But how do you keep people from becoming left out? Well, you can't let them fall so far behind to begin with, so that if you do lose your job, if your job does become replaced by AI.
I mean, that's easy to say now, but it's not a solution.
But it's what we have to do moving forward. We have to say, listen, this problem will never go away if we don't address it. It's just going to keep getting bigger and bigger and bigger.
So I agree with the whole tax reform thing, but I go back to the incentives. So the only again, the people who say this generally were proponents of a different political candidate in 2024. And what I say to them is, if this is so important now, if you're advocating for all these solutions now, why didn't the candidate you support say anything about this stuff? Why were they talking about price controls on food? Why were they where was the big idea of the tax reform and the citizens and overturning Citizens United and the doing the wealth tax? Where were, it was like this group of people, again, if you think everything's fine, if you think status quo works, you offer incrementalism. That's kind of like what the Labor Party is doing over in Europe. You offer just sensible next steps. And if you believe that we're at a real point of urgency, sensibility to a majority of the public is going, look at the price of everything in my world. Look, I'm looking at the news. It seems absolutely insane. We're on the verge of World War III. Look at the job prospects out there, right? It's 61% labor force employment. Look, and you want me to be, you're offering sensibilism? You're offering just a little bit of change inside the margin? How is that a recipe for success? And that's what I didn't get. People judge me all the time, like, oh, you voted for this. Like, they think they're so goddamn clever, all these people. Oh, you voted for this. No, I voted for inertia. I voted for a move away from status quo, and I was only offered that inertia in one candidate, like it or love it. And the other side was offering, just saying nothing. It was a bunch of, they were in handcuffs by their Wall Street donors. They could not offer labor anything they wanted because they got all their blood money from Wall Street donations. And when you are funded by billionaires, that's the thing. The narrative is that this other side, Elon Musk, and he's unelected, whatever. It's like, give me a break. Is George Soros elected? Is Reid Hoffman elected? Or is Mark Zuckerberg elected? All this money comes from somewhere to get these people elected. Those are not grassroots donations, people. So if we've got a problem, where was the sense of urgency to resolve this problem before we're barreling into tariffs and causing trade wars with the other people? Now I hear a bunch of people like you going, this isn't the right way to fix it. We should be doing this. And it's like, well, why didn't you say that?
I think you're mischaracterizing my position.
5 months ago.
I think you're mischaracterizing my position. My position in the election was that I did not think she was a good candidate, but I thought he was a worse candidate. And like you said, you wanted to vote for inertia, and he was the only one offering that. I can understand that. Okay, that is a logical response that I can understand. My view on it was that I saw him as potentially dangerous. I'll just use that word for lack of a better word. That is why I voted for her and not him. had you offered me a candidate, like I wasn't married to her, I wasn't out there saying, yeah, she's great, I really believe her.
Yeah.
No, I didn't, not in the least bit. And I'm sure if you went back and watched like any show I was on with Jamal or anything, I said it then too. I just thought that I can't vote for the person who I think could get us into a lot of trouble. I would rather stay in the trouble I know versus trading for the trouble I don't know for now, and hope to God in the next election we get somebody who actually recognizes the situation for what it is and brings new ideas to the table and isn't beholden to special interest or the people that have been funding campaigns forever. Somebody who can step up and say, hey, listen, no. We have to change.
I love what you're saying, but it's not possible unless you have to start with one incentive at the beginning and then unfold it and peel the onion to get to all the other incentive structures that are creating the outcomes that you see. And you're thinking, if I just got this benevolent person who could withstand all the incentive structures, then they could fix it. But I'm telling you, in my personal opinion, you go after as a public Citizens United first. Then the money is neutralized and you, as the masses, you have more importance. Then you can start peeling back the onion. But if we don't understand what the root cause is, you're not going to get some, oh, this guy's perfect or this lady perfect for the job. Because one person in a system of incentives cannot give you wholesale reform. That's number one. Number two, Josh, is I think we romanticize this idea. If you believe that we need major reforms, and what you're talking about, my friend, it's you want major reform delivered with incrementalism. And I'm looking back in history, and I don't know that I've ever seen that happen. In other words, if you want major reform, it doesn't come without somebody paying a bill. Somebody's got to pay for it, either in blood, in tears, in discomfort. All revolution or reform throughout history, if you're a student of history, there was never a group of people in the labor class who simply asked for better treatment, who simply asked for more rights, who simply asked for more equality, and it was given by some benevolent leader. And this, my issue, as I often and people, there's a person in particular in this chat who doesn't understand what I'm saying when I say, in order to win real reform, it must be paid for. There will be pain. If you really want real reform that is actually going to benefit the labor class, not lipstick on a pig like the ACA was, hey, we've got coverage. Oh, but now I can't afford the copay and I can't afford the out-of-pocket, so I can't even go to the doctor. I'm covered, but I can't go to the doctor. Yeah, but the politicians get to say that you're covered, and they fix the problem. If you want real, actual solutions, my thing is I think a bunch of people are looking around going, I want a better outcome and I don't want to pay for it. I want exactly what I have now, the same level of comfort that I have now, and I don't want to sit at a counter. I don't want to have to walk as they did in the Montgomery bus boycotts. I don't want to have to fight in a revolution. I just want better, and I kind of want somebody to give it to me. And I cannot find a point in history where that was true. So the people that want big reforms, I go back to you and I go, are you willing to pay for that? Because right now, in a weird way, capital is paying for the potential of redistributing this to more manufacturing jobs. We're paying for it. If we built 5 million homes in this country, Josh, what do you think more supply in this country is going to do to existing homeowners' equity? It's going to take from them. So the point is, for real solutions, people are going to have to pay. Somebody's got to pay for this. And I don't think you can get wholesale reform on wealth inequality, on taxes, on a lot of the things that sort of plague us today, on Citizens United. I don't think you get it for free, man. And I don't hear enough people looking around going, I'm ready and willing to pay for this.
I think you're completely correct. I think that, if you go back in history, just in the US, there was society was more cohesive. I'm specifically thinking of like World War II, where everybody was willing to either, make the sacrifice or accept the sacrifice being imposed upon them to get behind, what we were doing in the war. I'm not going to get into the politics of the war or anything, but people did. We bought war bonds. People, they went to work in factories that made ammunition and things of that nature. And somewhere along the line, we've lost that. Like, we became so much more about me and mine, my rights, my individuality, versus, recognizing that as the collective does better, so do I. Like, I have an investment in you, Victor. Your show does better. We bring in more viewers. That translates into more accounts being open. I get paid by the company. It's a spider web. Everything is connected. But somewhere along the line, and I don't know, there isn't like a particular point in time that I can say that was it. But we really got away from that. Hey, if I can lift people around me, it benefits me as well. It became about these individual liberties, and I need to get mine, and that's where the focus went. So I personally, yes, I'm willing to make a sacrifice, okay? I'm willing to make, let me qualify that, a reasonable sacrifice, okay? Yeah. I'm not going to go live in a cardboard box so that I can give my paycheck to social welfare programs. Like that's an unreasonable ask. But I am willing to make reasonable sacrifices because I do recognize that in doing that, the aggregate effect benefits me. It may not immediately benefit me, but it does benefit me. If more people are able to buy things, and I'm putting this at a very basic level, then that means we can sell more things, right? It's just, it's this individual focus on just, I got to get mine, that I for the life of me, and I consider myself fairly well informed. I can't find that point in history where all of a sudden we fell off that cliff. Like, I don't know if it was Kennedy assassination or. Go ahead.
Probably the start of a slippery slope. Can I ask you, when you hear the word nationalist, given what you just said, when you hear the word nationalist, does it have a positive or negative connotation?
It has a negative connotation. It's been hijacked. I think the word has been, I shouldn't say hijacked. I think the word has been applied in such a way that it has taken on a negative connotation. But if you want to get to the pure definition of a nationalist, it is a good thing.
Like, what's interesting is
it's the same with liberals. Like, being a liberal means that you change your mind as new information is available. That's what being a liberal is. But it's like, you're a libtard.
Where'd you get that definition? Where'd you get that definition
of liberalism?
Yeah.
Dictionary.
It's changing your mind when you have new facts.
I'm summarizing.
That's not even, I don't think you're close.
It is adapting. It's adapting with knowledge, is what it is.
It's dictionary.
It's adapting with knowledge. I mean, that, like, I'm summarizing it here. I'm putting it in my own words, but it is adapting as the knowledge increases. The more I know, like, I am not married to any opinion that I have, because if facts come in that dispute my opinion, I will change my mind.
Open to new ideas.
Yes.
What's interesting is you kind of hold two ideas at the same time. You early in the show, you said that, economies evolve and sometimes there are sort of losers that lose the evolution. They lose the capitalism game at the very beginning. And you also hold this idea of the collectivism over individualism, which you were just describing. So what's interesting is, like, I don't want to call it it's just you seem to hold two ideas at the same time. You hold.
I see them as married.
The system. How?
Because I think that while the evolution is going to leave people behind, I think we can lessen the burden that creates if, as a collective, we do better. So yes, I might lose my job to AI at some point, But if I have been doing better, and I'm not, that's a very ambiguous way to phrase it, but the fall for me may not be as great if I hadn't been so far left behind to begin with. I think people get left behind today and they're done. They're out. There is nowhere to go. And that's because they don't have anything. They have no assets. But I think that if we had a system in which people had a reasonable opportunity to attain more, that if they find themselves in a situation where their job has,
which is, I think one of our biggest issues is just money doesn't circulate in the in local economies
100%,
like it used to.
100%.
The money goes one direction, and those people know how to hoard it. They're not buying goods and services; they're buying assets. So on one side of the spectrum, you have a massive demand for assets, and on another side of the spectrum, you have a massive demand, probably too much demand, honestly, for goods and services. And if somebody in the chat earlier said that the cheap Chinese stuff benefits our quality of life. And I would say that's true up to a point.
Mm-hmm.
I would say that's true up to a point where Americans are saddling themselves with trillions of dollars of credit card debt, where we have buy now, pay later solutions on burritos and pizza. I think what's happening is you have cheap goods and services coupled with horrific financial literacy, horrific understanding of deferred gratification, horrific understanding of appreciating versus depreciating assets, an emptiness that people are trying to fill with consumerism. And you can only I think anyone that saying that money can't make you happy, I don't know, give you a lot of choices. But I think what the core of that saying is that you can't buy your way to some sense of happiness. No matter what you buy, you still you're still an individual searching for some sense of self-realization. Sure. And, a tricycle is not going to make you feel good. You know what I'm saying?
Well, me personally, no. I do look at what's the point of this? It's just mean. No, but your point is right. So it's money. Like, I grew up in a comfortable environment, and then I went through a period where I was dirt poor. And money doesn't buy happiness. It makes life easier in a lot of respects. It's just one less thing to worry about. But it's, but when you're buying on debt, on credit cards, and you're racking up debt, and now you're spending, the bulk of your paycheck to make the interest payment on cheap Chinese crap. Well, you shouldn't feel good about that.
Well, here's the way I would amend the saying money can make you comfortable, stuff can't make you happy.
Yeah, I agree.
So, and the way to get money is to acquire less stuff and more assets that appreciate over time. But people are trying to buy the stuff, they go into debt, and we spend, many people spend their entire lives never in the black.
Yeah.
From student debt to the mortgage to the credit cards, they spend their whole life paying off, I'm going to consume today, and I'm going to pay for this stuff later. And we don't have a nation of people who are more likely to defer consumption because that doesn't benefit the system that we've set up. So again, I think at some level, cheaper goods creates a higher standard of living because more people can afford the tables and the chairs and whatever in their home that they can afford. But I think there's an upside limit to that, and I think we crossed that upside limit a long, long time ago. And I think buying less stuff at this point wouldn't necessarily lead to less happiness if people were able to, with those less purchases, build up savings, more potential for future consumption. That's what they did during COVID. For as shitty as the COVID time was, people built up their savings, and generally, I think for all the negatives of COVID, people paid down debt and they had lots of excess savings. Now, unfortunately, that played itself out in a rabid consumer who just wouldn't stop buying shit. Like was buying everything.
Yeah, and that behavior hasn't changed. Yeah.
Yeah, but if on the flip side of COVID, okay, we come out and the mind of the American consumer has changed, and it's no longer I'm going to buy everything off of Amazon. Whatever it is, it doesn't matter. Ship it to my house. It'll be here tomorrow. If the mind of the consumer had shifted after paying down debt and building up savings, you got a very different reaction. But I mean, that's not our nature right now.
I think that this ties back to what I was saying earlier about, I think a lot of what drives us to buy things to try and make ourselves happy is related to the fact that, community isn't what it once was. Like when I grew up, there were neighborhood block parties. I played with the kids, I came home and I went out and I played with the kids in the neighborhood. Now we've become a much more isolationist society. You come home, you play on your PlayStation, your iPad, whatever. There isn't this, let's get together and do things. And I think that the effect that has had is that we buy things to supplement or to replace, that sense of community that was once so popular. I mean, there were block parties all the time, and I knew everybody and you did things, but now it's like, I don't even and I'm guilty of it. I don't even know my neighbor's name. Okay, I've been living across from them for 8 years, and I don't know their names, and I feel crappy about that. But it's like I don't.
That doesn't surprise me at all.
That is kind of on brand for me, I guess.
Totally on brand.
I don't even know how I end up on this show with you. Who are you?
You 100% are the get off my lawn neighbor.
No, but I'm not. I enjoyed those things, but I do think that as we've become more isolated as individuals, we've turned to buying things and trying to replace,
community.
Instead of going out and playing with them. Yeah, it's just
with consumption. I agree.
Yeah, I'll replace my friends with cheap Chinese goods off of Temu or whatever.
And by the way, we keep saying cheap Chinese goods. I don't mean any disrespect. You know what I mean? No, it's just they have a comparative advantage in labor, and that comes across as a cheaper good, and I don't want that to have any negative connotation. I have a Singaporean Chinese wife, so I need to say that, and 2 half Chinese.
No, it's fair. It's fair to say because I don't want to be construed in the wrong way either. But we will replace relationships with stuff, and that's not only to our own personal budget detriment. It's also, to the detriment of the broader economy, and that we don't see the benefits of when everybody, when your neighbor, it's a lot easier to say, yeah, I'm willing to make a sacrifice for that person, right? When I don't know the name of my neighbor, and I'm talking about making sacrifices, it's a little more difficult to pull that one, right? So
they know you. They don't know you by name.
Oh God, they know me.
The naked guy in the windows there again, mommy.
Yeah, they definitely know me. Why does he turn the music up so loud? It's because he's going deaf. He's old.
I can only imagine the music you listen to at home.
I listen to great music.
Kyle Hamill says I'm CYAing. I am a bit. All right. I think we solved the world's problems today. It's interesting. We have a much more civil conversation in person, and when we're looking at each other's faces, than we do on our phones. On our phones, you're an effing idiot. You're an effing idiot. What did you go to third grade?
Back on the text.
You never got past third grade.
Yeah, there's a difference.
We just call each other idiots who've drank the Kool-Aid from the other side. I say you're propagandized by MSM, and you say I'm under the hallucination of a con man. We just go back.
The only person who doesn't change is Tom. He will be the exact same in person as he is in a text chain like that. But yeah, we do have better, more civil conversations. And actually listen to what you say in person, whereas with your texts, I'm just that's too long to read. I need AI to summarize your text for me. You've been replaced. There you go.
Give me 3 points from his long text. All right, VIX, as you mentioned, vol was kind of quiet for the early part of this sell-off. Yeah. We've now sort of gotten into a level that gets spicy, and we're in pretty decent backwardation as well. Yeah. The first time we got into backwardation, I took a lot of risk and sold the big handful of those big VX futures, which I don't normally do. I usually play a lot smaller than that. But for some reason, I know the odds say I should get in here and sell vol. But I also know backwardations can last a long period of time. I think in 2008, it was something more than 60 days, 60 plus days. In 2011, we had backwardation for somewhere around 70 days. So getting into deep backwardation on day 2 with, I think, what is likely going to be a very complicated 30 or 60 days, I don't know that I'm as willing to jump in here and try to take explicit short volatility positions through short VX futures. I don't know that that's why I want to play it. I'd rather play small, long deltas and stocks that I think are getting cheap, because I ultimately think this is going to end in a big print from the U.S. I just don't know when it comes. It could be 2 months from now. It could be 6 months. It could be longer. I think this ends the same way it has always ended. And I think you want to have hard assets at some point. I think you want some equity exposure. I think, in 2022, I bought a bunch of physical gold, and everyone called me a crazy person. They called me a prepper because I had gold. I have nickel. I have platinum. I have silver.
You have iodine.
Call me crazy. I have iodine. I do. And he called me crazy, and now here we are. I mean, gold was probably 1,600, 1,800 then. And here we are at 3,200, and everyone's scrambling to get it at Costco. It's just kind of funny how the world evolves like that.
Do you still have your physical gold?
Yeah, I sold a little bit, but not, I still have a lot of silver.
Okay. Well, to your point about the VIX, listen, I just looked, the VIX futures are 26 and change. That is not panic levels, okay? So it's not
panic, but it's elevated, bro.
It's elevated for sure. It's definitely elevated. But for me, and I think for a lot of people that I've spoken to, 30 is kind of that level where, like, you don't want to be too far from the bathroom, right? It's like, this is where my stomach starts to do funky things. And I don't, the backwardation, as you said, it can last for a while. I don't think, we're necessarily out of the woods. You've got an employment number coming out tomorrow that, in my opinion, is going to take on greater importance just because it's coming in the midst of all of this. You have a weekend coming up where I think there's potential for, other governments to come out with how are they going to respond to the tariffs.
Yeah, while the markets are closed. I think that's the most likely scenario too.
Yeah. So I'm with you. Today I was out there looking for things that were down around 10%. In addition to what they'd already, there are a lot of choices actually. In addition to have already fallen substantially, and like, okay, I'm gonna get some long delta. Like I sold puts in Starbucks. I sold some. I'm trying to remember what else. I can't remember off the top of my head, but that's what I was doing. It's like but I was going very small. Like, I'm gonna dip my toe in the water here. I'm not jumping head first, because I'm not convinced this is over. But I am going to start dipping my toe in the water a little bit on some of this stuff that, there's stocks out there, they're down 50+%. And it's like, okay, well, I don't think you're going out of business. And the sun just came in my place really bright. I look kind of angelic. You like how I call myself angelic?
That's what you think? That's what you think you look like?
Either that or...
Bro, your self-awareness.
They're coming for me.
I wish I had the self-confidence that you have. God, you've said on this show so far, I like to be I call myself very well-informed. I look angelic. I wish I had your confidence, bro.
I have zero confidence. Trust me, I have zero self-confidence.
The non-farm payrolls, to your point, consensus is 131,000, which would be a fairly light job report. The expectations for unemployment rate to tick up from 4.1 to 4.2%, which is inching us closer to 4.4%, less people participating in the job, in the labor force. Good God, come on, Victor, you do this for a living. I agree with you. All eyes there. Can I ask you, do you think, I suppose it depends on what price they give us. Because if we get stupid cheap, then there will be some people that take some risk into Friday over the weekend. But do you think the typical default disposition on Friday is going to be, I don't really want to hold risk over the weekend? Or do you think it's the opposite, that people might want to hold risk because the greater potential after we had this massive sell-off is for, it's like, where do you have the jump risk? Is the jump risk to the left of the distribution, or is the jump risk to the right? Do you think it's evenly distributed here, or would you rather lean one way or the other, specifically just for a jump risk, just for the 2%, the 3% move in one direction? Where do you think that rests? On the left side of the tail or the right side?
That's a great question, because I have been of the opinion that the risk was to the left. And Fridays I was getting short for probably since
Congratulations. Nice move.
Yeah. No. But then Fridays would be huge rallies. I mean,
I thought you said last Friday you got short.
No, not last Friday. No. I had been doing that, and Fridays turned into big rally days. It wasn't what I thought made sense didn't play out, which might say something more about me than anything else. But I think that heading into this weekend, I'm of the opinion that the risk is to the left, that there's downside risk here, that, because you could have retaliatory tariffs, and then you could have retaliatory to the retaliatory tariffs. Like, there's 2 days where I can't do anything, and I don't really want to get caught holding anything. So my plan for the weekend, I'm actually going to go in relatively flat. I don't like the lack of I don't like being beholden to Sunday night. What about you?
I think as a pattern, I would never bet that pattern. I heard a couple people talking about people selling on Friday, buying on Mondays, and just because it happened, I think it happened like 2 weeks in a row. And then I talked about it on this show. I go, don't do that. I go, that's.
I just thought he'd announce tariffs over the weekend. That's what I was waiting for a tariff announcement to take place on a Saturday, and I didn't want to get caught Sunday night opening down 50, 100 points.
Oh, then you don't know when the best time slots are for television then, because that's how he makes his decision. He wants ratings, bro. You don't know this guy yet.
It's a very fair point.
You don't know this guy.
Yeah. Between like 7 and 10 p.m. is probably on, like Tuesday through Thursday is probably when something's going to happen. Thursday night, yeah.
So I think from here, I am nibbling really. I had a large cash position, and I can't even tell you. I can't emphasize how small the buys are right now, and they're few and far between, and only on targeted assets. Most of them in the material space, because I do feel at some point this is going to end with more liquidity, and if that's the case, I think anything that you can't print is going to go up in value, and so I really like buying targeted material stocks here, though I think everything goes on discount. And the question becomes, I can't tell you how deep I think a recession will be or growth slowdown will be, but the market is in the process of answering this question. The fact that bonds go from 115 to 120, the fact that every consumer discretionary company just got murdered today, the fact that every casino and disposable income company got murdered today. Mm-hmm. I think the fact that crude oil, in some respects, that global growth is being priced in a slowdown, I think you're in the process. This always shows up on your screen first, and it shows up in real life later. And I think it's going to markets are going to tell us how deep the recession is likely to be, how aggressive the Fed is going to need to cut into this. And I think I don't have a real answer for what I think makes the most sense maybe it's maybe a bona fide 20% bear market makes the most sense before you start really getting aggressive to look at a shopping list, and we're only half of that right now. We're only at 10%. But
I think what you did is kind of like what I did. Like, okay, I'm not going to give up my coffee. Like, that'll be one of the last things I'm going to give up. So I was willing to get long Starbucks. I looked at DraftKings, was getting crushed, and like, okay, that is the type of thing people will give up. They'll stop betting on sports before they'll give up their coffee. And I mean, it's a very elementary. It's about as elementary as you can possibly get. Yeah. But like, if I'm going to dip my toe, it's going to be in the things that, yeah, these might take a little bit of a hit, but I don't care what the economy does. Starbucks is going to sell a lot of coffee. As long as I'm alive, they're going to sell a lot of coffee. But DraftKings, like, okay, do I have to bet the Final Four this weekend? If I'm really worried, no, I don't. I could take the money in my DraftKings account and move it over to buy more coffee, or whatever.
What are they putting in your coffee? Well, I don't understand how. I kind of get what you're saying, but I also think everything's relative. If you were telling me you were long Starbucks and then short something against it, then I sort of understand what you'd be playing is the Starbucks outperformance relative to some other thing. But but we can get correlations to one where people just are like, I'm paying a 20 plus multiple on the earnings for these stocks. And even if I feel like the earnings might stay stable or grow, I don't want to be paying 20 times in this environment. Instead, I want to be paying 15 times. And that multiple compression is likely to occur. And what I think, if you believe we're headed into a growth slowdown, you can also get an earnings. Basically, people bring their estimates down. So what you're going to get, likely, I think, is earnings coming down, earnings estimates coming down, the multiple that people are willing to pay coming down, but people pricing in lower rates in the future, which makes future cash flows more attractive to the net present value. So you got all this stuff shifting, but I think net, I don't really think it matters who you are. Maybe some defense contractors are going to be okay because we seem to not be touching defense spending in any of these budgets right now. Maybe they stay all right, and maybe Bitcoin, honestly, it's hanging in there at 80 to 90. I wish we could get a flush. I wish we could get a nice flush.
That's
but
the one
I think
everyone's figure out.
Everyone's thinking what I'm thinking. And I think when everyone's thinking what I'm thinking, you don't get the flush.
Yeah, I agree with you on that. And to your point about earnings and the multiples and the estimates, I completely agree with you. That's why I am dipping my pinky toe in the water with these things. It's just like, hey, listen, I'm willing to take the risk on a very small position. Yeah. If I'm wrong about my longer term view. But the Bitcoin thing, you bring that up, and that's when I scratch my head over, because I think, like you, I've been waiting for the flush, and it isn't happening. But I just don't understand it.
Because what? You want to buy it, and you want to buy it cheaper?
I probably would buy it. I mean, I don't, I'll be very, very transparent about this. I'm not a big fan of crypto. I can't explain it. And if I can't explain it, I don't want to own it. But I recognize that there's an opportunity in it, as the trader in me recognizes the opportunity. So, if it had that flush, yeah, I would trade it from the long side, without question, in the futures or something like that. But I don't understand what's keeping it at this level. And that goes back to that I just don't understand it. I don't understand what's keeping it at this level. I don't understand why it hasn't been flushed with everything else, or was the 20% or whatever it dropped from its highs, was that the flush? Is that what a crypto flush looks like? Is 20%? Is it huge washout?
That's a baby flush in Bitcoin. You know what I think? I think there are times when on this show we've said that the market was leaning into the right distribution. So it was trying to say this without using fancy terms, but it was right distributed. So the probabilities that you got a market that crept a bit higher, or that you had positive drift that played itself out in the market, it was higher. It was higher probabilities of an upside market, but a fat left tail, which meant your pot odds for betting on the 2 or 3% flush were higher. And sometimes, even if the probabilities of going up, the likelihood of going up, you're getting paid so much to bet on that fat tail that the risk and reward favors it. I think, and this is not me looking at any term structures here, this is just me telling you how I'm reading this. I think it's flipped. I think we're in a slightly left distributed market where the slight odds towards more slight downside pressure each day is high. And I think you got a fat right tail.
You're talking equities or crypto? Or both?
Equities.
Yeah, okay. Yeah.
I think you got a fat right tail, which is if you were to get some positive development on the trade front, that causes this short covering rush and these violent bear market rallies. And I think that's probably the environment that we just switched ourselves into. But the tough part is if you have inventory to sell, like let's say you're not comfortable with the amount of risk you have on, you think you're too long. The hard part is decide. The best part of a bear market is if you can sell early. So if you're not there yet, you're you're 10% down already, and now you're like, oh shit, what do I do?
Exactly.
You know what I mean?
Is it worth it to sell it? Yeah.
Yeah, you don't want to puke after a 5-6% down day. So I can tell you, there's a bunch of people out there that feel like they're a little bit too long, and they just want an extra 2 or 3% high. Let me get a 3% rally. Let me get back, and then I'll distribute the rest of this stuff. And if that's true, we keep leaking lower, and those people never get a chance. And then when those people finally puke, that's like your marker of we're going the other direction.
Yeah.
Maybe not like long term, but it's like the short term.
Oh, it's yeah. I mean, we get 1,000 emails from people saying, "Hey, listen, I'm down, 8% on this position.
Yeah.
Should I sell it, even though we're down, or I'm wait, or no, or they'll say I'm gonna wait for that up move and then I'll sell it." Okay, but if you can tell me when that up move is coming, that'd be very useful information for me as well. because I'd like to be in on that. But you're right. What happens is they wait for that, then you get that big move down. That's when they puke, and that usually marks at least a short-term bottom. I mean, I am the poster child for that exact phenomenon.
You know what? And the bottom comes when you stop hearing about the bottom. So like what happens early in these sell-offs is everyone else, you'll hear it regardless if they're calling for it. You'll hear it a lot. Are we at the bottom? Do you think we've reached the bottom? How far do you think we have to go until the market? You'll hear all that stuff. When it finally is over, people are like, I'm exhausted asking that question. It doesn't even make sense to ask it. It's going down tomorrow. And the irony is the social cue is when you stop hearing that word being used in financial media. You won't hear it as much. And when that signal goes down, then you go, okay, maybe people have given up, and that starts to get interesting.
I look for that weird social tell, like all of a sudden, like it's not even in the market talk. It's just like something else. It's like, nobody's talking about their portfolios anymore. Like nobody brings that up. And it's like, oh, okay, we're probably at the bottom here.
What's wild is that exact same thing happened in 2022 because everybody and their mom was like a financial YouTuber all of a sudden, know?
Yeah.
And then 2022 comes out and it flushes everybody. All these people have been talking about stocks. Now all of a sudden they're talking about, culture stuff or whatever. They just completely move on because they go, oh, this is hard. And I don't know what before I was just picking a stock and I would say it was going here and it would go there. So I thought I was a genius. And now when you get into these environments, it's always funny because the amount of people that come and engage with tasty content is really high.
Yes.
Because when everybody else, when all their widgetry and picking a stock and saying it's going to go to this point on the chart, when all that shit gets exposed for the fraud that it is, people go, oh, this is about the distribution. And how do I play the distribution? And then it's like, okay, welcome. Let's have a real conversation instead of all that tarot card reading bullshit you've been listening to
We're like
up
rehab.
until this point.
We're like rehab.
Josh Fabian, man, I thought this was going to be a complete waste of time, but I'm pleasantly surprised.
I got dressed up for it because I thought I'd be on for 5 minutes and then you'd kick me off.
I really enjoyed the conversation, Josh. I appreciate you taking the time out of your likely busy schedule of staring at the neighbor kids through your window.
It's funny you say that because they actually stare at me through the window. They're like, "This is a guy in the wheelchair."
I sincerely appreciate your time, man. You're misguided on most of your political opinions, but I appreciate you coming on and sharing them with the public. Josh, if the people want to follow you, not only on your Twitter account, but you've got a pretty, I think, what is a dope podcast. I'm probably gonna get in trouble for plugging this, but if you want to, do me a favor, tell people where they can follow you on Twitter, and tell people the name of your podcast.
Well, actually, we're going to rebrand the name of the podcast.
Horrible name.
It's a horrible name, so I'm not even going to share it. We're going to rebrand it to "Does This Have Legs?"
There you
which
go.
I think is a much better name.
There you go.
And that'll be our handle on social media as well.
Okay, and your personal Twitter account?
At Josh_plain talk, I think. That sounds right. Yeah. So thank you. Thank you for having me too. I really appreciate it.
For sure, man. It was a lot of fun. It was a lot of fun. And I hope you'll come on again. Everybody in the chat, do me a favor before you get out of here. Hit the like button. Subscribe to the channel if you haven't already. If you want to follow me for some strange reason on Twitter, you're more than welcome. At Victor Jones. The Owen Jones is 0 because I like to be difficult. If you want to send me an email and outline any or all of your grievances, you're more than welcome to do that in a more private setting it's victor.jones@tastylive.com. Make sure you go follow Josh, show him some love on Twitter, but be aware you're just going to hear a bunch of a guy with TDS shouting into the ether. Josh, I'll see you next time. For everybody else, this is Synthetic Friday for the show, so we'll see you back here on Monday, same time, Sunday for first call, and then here on Monday. I'll see you back here, same time, same place, same great network, only on Tasty Live. Till then, peace.